kind of three things. The first one is reading the signals. And so why did I buy last year? What happened in 22, 23, 24, and before? And so, timing is really, really important. So that's secret one. Secret two is, what changed in 2025 that made me deploy capital, real capital, and really start kind of firing the engine back up in our company. And then three, there's some positioning that we could all do, whether you own stuff, that we're still going to see a little bit of pain, and we're still going to see some, I would say, red flags in 26, perhaps even into 27. So those are kind of the three areas that we're going to focus on today.
Yeah, and I can't wait to hear more. I remember you bringing this up, but we'll tell everybody as well. You're going to tell the story about how you, because of that 2026 positioning, you killed a very large purchase in Vegas, and you're going to get into those details and why you killed that deal as well. So I'm excited to hear more of those details.
Yep. So I think the first thing that, why did I call Tarl and chat with him, and why are so many people buying, let's say in 22, 21, 23, when it's clear to me that it's probably not a good time to buy. It's probably peaking. And if you guys have ever seen a bell curve, from my standpoint, why is that? Why am I seeing things that other people's clearly aren't? And I think that, and so that's really what I wanted to leave with you guys today. How do you read signals before the crowd? And to me, they're quite obvious, but this is really what made me pull my foot off the gas. So my partner Ross and I, we're in our 25th year of business. So obviously we've been buying and selling real estate for a long, long time. We've done over 3 billion, and we currently own about 2. Well, so when we had the capacity to buy in 21, 22, and 23, why didn't we double down, triple down, quadruple down like so many others? And so here's some of the early signs that we saw. The first one was, when you guys all know, when inflation hit in June of 2022, it went to 9.1%. And so while that might not be meaningful to a lot of you, you got to understand, what happens when inflation jumps that high and why. And so certainly we can go back into why. I believe a lot of it had to do with the stimmy checks from COVID and a bunch of other things. But regardless of that, it went up to 9.1%. And then what the Fed did, Jerry, if you could pull up that next slide, you'll see that the federal funds rate, it's really important. So take a look at where it's at the lowest. It's January of 22. Now, what's really interesting, this is what I really want you to focus on. Interest rates at this point were 3.1%. Okay, that's really important. So what happens when interest rates are really low? Well, people start to use debt. They start to use it for all kinds of stuff, whether it's a car loan or whether they're improving their home and they're getting a HELOC or, a home equity line of credit, or maybe they're buying apartments or whatever. But essentially, they're going into debt at this point because debt is really super cheap. So in January of 2022, that was about 3.1%. Then what happened was, as you guys can see here, the federal funds rate got ratcheted up a lot. And you can see how high it went and how quickly. Now, why is that important? I'll tell you why. Because what that basically should show you is that the cost to borrow went up a lot. So instead of 3.1, interest rates doubled in 9 months. So that's the most important thing to understand. So if you guys own, like, whatever, you own a floating rate debt and you're sitting there at 3 and you're happy and you're cash flowing, and then it more than doubles, the chances of you cash flowing is really low. So what this hockey stick increase should represent to you is the cost of debt, which arguably is the largest expense you have. So when you're financing some kind of real estate, this increase in the federal funds rate and the interest rates that it grows your largest expense. And when your largest expense grows in the form of a mortgage payment, then your cash flow evaporates. So this is essentially the fuse that created all the early problems. So I started to see this, and this is about the time I started calling Tarl. I said, you got to be careful here, because what we've got is we have a lot of people that are going to be, they're on floating rate debt, they're in construction debt, they're building things, because when you're building something, you don't have fixed rate. It's a floater. So basically you're floating in the market. So if you have any kind of interest rate that's floating here, then your interest payment is going to go up during this period of time. So what that means is there's going to create stress, but this is a very early signal. So you were looking for a red flag. It's an early signal. So do you remember when I called you, Tarl, and we're talking about this, right?
Yeah. So I had I at the time, I ran a real estate business where I bought single family. I kept a lot of them. I did the BRRRR strategy, buy, rehab, rent, refinance, repeat in Seattle, Washington, flipped a lot. But I always had like 17 to 20 active rehabs typically, right? Most of the time. So that's a lot of projects, a lot of capital. That's single family, especially in an area that the average purchase price for a single family is between 500,000 and $1 million. So a lot of capital out. And we were just blown and going, because even though the market was like, I knew it wasn't going to last, but it's kind of hard to like stop buying when in single family in a market that's like constantly going up. You're like, dude, like this is pretty good. So at what point do we stop buying? So when Ken called me, I was just doing business as usual. I was like looking at it. I wasn't overly concerned too much yet, but in the back of my head, I was like, should I be buying more right now or not? And then Ken makes that phone call. He's like, you should probably wrap up those projects and get rid of them. And so I'm like, yes, sir. And then I immediately literally got off the phone, called my project manager and my team members. And I was like, where are we at with all these projects? And then just started nailing them out and getting them on the market. We lost some money on some of the deals, but it probably would have been a lot worse if we just like did business as usual. We would have bought more too at that time. And the knife dropped.
That was kind of the lesson here, So for me, they're like, why did we pull our foot off the gas as well, right? So I also want to just point to you, if you go back to 21 and 22 when rates were really low, this is when there's a lot of syndication, deals are making sense. The prices are going up a lot here during this period of time, like a lot. And Jerry, can you click on that next slide? Let's take a look. And so I want you to click to the next slide.
I want to take credit. I'm clicking the slides.
Okay, good. There you are. Okay, so now let's take a look at this is the price index. So what happened is as you guys can clearly see in 21, look when the price started going up. Okay, so you start. It's a steady growth until 21, and remember rates were low in 21 and 22. Right until mid 22. So low rates create price inflation. And I think that's what I wanted to show here.
So quick question, Ken, on this chart though. So what is this actual chart? Multifamily real estate apartment price index. What is that?
Yeah. So this is how the prices rose during that period of time.
Got it.
Right.
For multifamily.
Yeah. For multi. Right. And of course I'm obviously going to stay in that lane, but I think the real lesson here is, why do prices go up like this? I mean, seriously, right? All things being equal, it's the low cost of debt. So if you just take a look at 21 and 22, and you can see how it spikes and kind of peaks at just before 23. Now go back to the federal funds rate again, and you can see, there you go. So it lags a little bit, right? And so what happened is when you start to see the federal funds rate go up and interest rates go up, that's when people pull off the gas, because let's face it, you got your income, you got your expenses, that's your NOI, your net operating income, and then you have your debt, and after that is cash flow. So this line here represents a reduction in cash flow to me. Right. And that's what that means. And so click back to the price again, and you'll see then it starts to taper off, right? As it would, right? So as interest rates go up, you start to see the index go down. And the reason is because now I can't pay as much. So if I'm buying something that's, let's say, $500,000 of cash flow in 2021, and rates go up, and now I have 100,000 of cash flow, I'm going to offer less because I'm trying to solve for 500. And so that's how this works. And so debt being the largest cost, the cost of debt went up. It pushed prices up. And then when interest rates went up, of course, prices started coming back down to earth. And so what I was trying to do, and the reason I called you, Tarl, and the reason that we took our foot off the gas is because we were competing, trying to buy real estate during this time as well.
Yeah,
like you don't just shut it down. Like, so we're looking at let's say a $30 million deal, just like everyone else. And, and I'm offering, 28, 29 million, and it's got a certain cash flow. Well, there's people bidding 31, 32. They're stretching for deals just like they did in the single family house, where, when there's not a lot that, they push the price up, right? There's, I call it irrational exuberance. So,
Yep.
So we were unwilling to stretch. And also don't forget, I am also trying to solve to my investment itself. So if I'm going to make a $10 million investment into a real estate deal, I'm going to want $500,000 of cash flow to $1 million of cash flow a year, right? I want a 5 to 10%. So if it's, and as debt goes up, then the cash flow goes down. I'm not going to offer as much for that. And so that's what you see in the correction. So, but here's the interesting thing, Tarl. There's a lot of people that kept buying during this time.
Yeah. We know some of them.
Yeah, we know a lot of them. So they kept buying, they kept buying, they kept buying, they kept buying. And why would they keep buying? Because they could. Like, you know what I mean? Like, they were raising money and they were buying into the price appreciation, and the interest rate, was continuing to go up. I didn't know how high the interest rate would go. No one knows. But I did know that it was going up, and I did know inflation was at 9.1, and I did know that the Fed was trying to bring it down to 2. So again, a red flag. So the red flag was the Fed's going to do everything that they can to try to cool down the economy, to try to get this inflation under control. And one of the levers that they use is interest rates, if that makes sense. So that was one of the big red flags.
Yeah, it was huge. And I mean, there's people that we know during this time period, because what happened is that, just for, looking at like back in the past, is that people would start buying in 2020. And I mean, like, newer syndicators, even some seasoned syndicators, would start buying multifamily in this time period and start raising capital. And then they would sell, and they look like geniuses, right? Because the rates were so low, the market went up, and they looked great. They sold, and then they said, let's do it again, right? And then they go buy and raise in 21, and they're expecting it to go again. And then they buy and raise in 22, and then a knife drops, right? And, and this, I don't know if I'm getting ahead of myself, but I'm thinking of one, without naming names or deals. I know somebody that bought an $80 million apartment complex here. And I think last I checked, based off of what I understand of that deal, I think it's worth about 35 to 40 million right now, right?
Yeah. So that's very common. And that's what that price dip is. So it's a really good point. So there's a lot of people that bought at the top of that bell curve. And I think that is, as I saw prices being pushed up and cash flow going down, that's when I called you, Tarl, as it was spiking there in 2022, right around there. And I said, hey, take your foot off the gas. Let's let this thing, let's let it run its course, because it will run its course. And I, every single time I buy something, I'm not buying it to sell it a year out or 2 years out or 3 years out. I'm buying it for cash flow, always. And then I, of course, want the appreciation, but I always focus on cash flow. So as I started to see cash flow evaporate because of the high interest costs, I'm like, time to take my foot off the gas, hit the brake a little bit, sit back, evaluate, and let the prices correct. And one of the benefits, of course, Tarl, is I've seen this show before, right? Like I've sat in this seat and watched this exact thing before. I started investing in the late 80s. I saw it in the 90s. I saw it in 2000s. I've seen these cycles before, and they're always the same. They're fueled by cheap credit, and then there's a bust. At some point, there's a bust, and while everybody's buying and all that stuff, they're losing track of the basic fundamentals, which is cash flow. Like it has to, like the only way an investor is going to get paid is if it cash flows. And so all things being equal, as the prices started to come back down, that's kind of when I jumped in again. So if you go back to the other chart real quick, let me show you something. Now let's go all the way to the right side. Now, obviously, that's where we are. And this is when I've started getting active again. And take a look at, we're almost at what, 2000 and was it 2010, right? 2000.
Wait, which one are you talking about?
I'm trying to take a look at, when the prices are, if you go look back at history, right?
Yeah.
Let's go. Yeah. So what you have is you've got, you lost like 5 years, 6 years of value there, right?
Yeah. So you're saying, so basically this chart saying Q3 2025 is the same price as what it was in 2021.
Yeah.
Yeah.
Right. Yeah. So in 2021, so that's where we are. Basically, anything that's happened from that point came back to earth before interest rates went up. Yeah. This is the most important thing to remember. Interest rates were about 3% during this time. So what you had is you had a big gain that was propped up by credit. A lot of people bought, and now it's deflated. And to your point, like that example where you had somebody that paid 80 million and now it's worth 40. So that's all being repriced right now. And there's all kinds of scenarios happening right now. And so the cool part is, the interesting thing is, even with the higher rates today, the question is, does it cash flow? Because I always just keep going back to that. So obviously, I'd rather have a $40 million property at 6% cash or 6% interest that cash flows than an 80 million that doesn't cash flow. You know what I mean? So the prices just reset. That's what happened.
Yeah.
And now, of course, if you go back to that federal funds rate real quick, the early, 2 slides ago.
Jumping ahead.
One more. Yeah, right there. That's fine. Now let's take a look at what was also going on, Tarl. So you see how the flat area up top there in 24, right? Nothing really changed. And then as you guys know, we got a quarter point here, quarter point there. And so rates are gradually coming down again. Okay, now, are they going to come down to the way that they were in 2021, 22? I don't really know. I don't have a crystal ball, but the fact that they're coming down makes some of these deals a little bit easier to buy because, again, I buy for fixed rate debt. And if the fixed rate debt now makes a cash flow at $40 million, it's better than paying 80 and having it at 3, right? So again, I'm just always solving the cash flow. And I waited for the price to reset. And then 2, I made sure that no matter what rate is today, it cash flows today. I'm not banking on tomorrow being better, if that makes sense.
That makes a lot of sense. I mean, like since you and I being partners on things, like one of the benefits I've gotten out of that is becoming what we like to call a recovering house flipper, which is somebody that likes to keep properties instead of flip them all the time.
Yeah.
And so cash flow is all I focus on today, right? And thank goodness that I did that years ago and started focusing on that because during this time period, I didn't buy anything during this time period either, right? I started buying in 2024 again, like mid 2024, bought a bunch of stuff in different markets, watched again, and now I'm buying a lot more currently, but single family related, and we can get into that later. But everything I'm looking at and purchasing is cash flow related. Even if I'm doing the BRRRR strategy, buy, rehab, rent, refinance, repeat, it still has to cash flow at the end of it. And so that's something that I've taken a good lesson on. I've made a lot of money flipping, and it's also when the pendulum swings back, it's like a wrecking ball. Like if you don't do it. Right. So.
Yeah. And so I'll just give you a quick story. In 2005, I was buying property in Austin, Texas, and I looked like a genius. You know what I mean? And I was like, this is great. A couple hundred units here, 200 units there. And we were crushing it. And then the GFC, kaboom, right? And so
Yep.
you guys all know, a lot of you went through the 2008 crash. So what happened during that time? What happened was whatever I paid for those assets, the values went down. Period. Okay. But what saved me? My tenants, my cash flow. So it'd be the equivalent of you buying a home for 500 grand and a year later it'd be worth 400 grand. It doesn't really matter because, you're paying the payment and, you're moving along and maybe it'll get back to 500, maybe it'll go to 6, whatever. But the temporary drop in value is not as important as the cash flow, right? And so what happened was the cash flow from the tenants helped, and we just wrote it out. Now, of course, we didn't expect any of that, right? But the reality was, the interesting thing about the GFC, and a lot of people don't always connect the dots here, but when those 4 million homes went onto the MLS during the GFC, and it was a bloodbath for single family, as you know, Tarl.
Yep.
Okay. Where did those people go? They went to rentals, right? Because that's what they do. Now, some people moved in with their parents and, there's all kinds of scenarios, but the reality is the overwhelming majority of people that lost houses during the GFC moved over into the rental market, as you do. You default back one, let's say, and you move to rentals. What that did is it put an incredible pressure on the rental market. So it actually helped the rental market.
Yeah.
So the single family and multifamily are oftentimes counter-cyclical, and most people think they're related, but they're very, very different, because if interest rates are really low and home prices are reasonable, then people are moving out of rentals. That's just a fact. That's what happens. Right now, we have home prices really high and interest rates high, and so it's the people are holding they can't afford a single family, right? So the gap between rent and mortgage is extremely important. If you're a landlord, you want that gap to be really big. If you're pushing for affordable housing, you want that gap to be really slow or really, really low. So I think, it's all based on your perspective. If you're a renter and you want to buy a home, you want a low priced home and a low priced mortgage, right? If you're a landlord, you want to be in an area where the mortgages are $4,000 or $5,000 a month and your rents are $2,000. So it's pretty common sense, but and so that's kind of how the game works. And so when I saw the federal funds rate kind of going down again, and the values were also being repriced, as we've already mentioned, and I said, okay, it's a good time to start looking again. And that's why we did almost 1,400 transactions last year, or 14 transactions, not 1,400 transactions last year. Now that's new development, that's refinances, that's recaps, that's new acquisitions. That's all over the place. But we had a very, very busy year in 2025.
And we're going to get into that on the next secret. So
yeah,
which is awesome. And so what does it mean by this slide here, Ken?
Well, okay. So again, what happens is when rates go up, guys, here's what happens. When the federal funds rate goes up, if you're a lender, you're like, okay, like it's harder for me to sell people fixed rate debt. So I'm going to create these floating products that are cheaper for people to use. And all these people go do that, right? So the smart thing would have been done,
or something like that.
Yeah, the bridge loans or the, the smart thing would have been for people to fix their. I think you always got to fix what would be your largest expense, and that's a great way to know what your mortgage payment is going to be in 1 year, 2 year, 5 years. So. And they didn't do that. So what happened was they were buying debt with variable rate instead of fixed, and so their largest cost of the asset that they were buying was unknown, and to me that's massive risk. And so what I always want is to know, like, what's my mortgage payment going to be today? What's it going to be in 1 year from today? What's it going to be in 5 years from today? And you can actually do that. You can actually lock, fix, and then you just ratchet on the way down. So if rates go down, you just refinance again, and then refinance again, and then refinance again. So you can ratchet on the way down, but what you really want to do is you want to hedge the upside. You don't want to be in a situation where your largest cost is variable. And that's a big mistake that most people got into here.
Yeah, and I was fortunate to have a mentor many, many years ago when it came to like debt structure and finances, where when I was like, hey, I have this chance to get this variable rate and this or whatever. And he said something that clicked with me. This is probably 10 years ago or whatever. He's just like, always go with the fix, because I don't want to be forced to have to think about that property again. And that was like, that's stuck in my head. I'm like, oh, yeah, I don't want to be forced to have to think about this again, right? So like keeping the faith. So that worked for me. Whether or not, I think what happened here with some of these deals, and you know this too, is that the only way they could get the funding, the only way they could make the deal work is if they had a variable rate. Some of these guys that bought during this time period.
Yeah, perhaps that could have been the case. Well, it also could have just been priced better, right? So so fixed debt, you know, a lender can price how they want, right? So fixed rate debt is more than a floater, right? On the day you do it, right? So now 6 months later might not have been, but you know, you get the point. So, you know, but again, you're adding risk when you don't need to add risk.
So let's continue. So the results between 23 and 24, what happened to your portfolio versus the markets?
Yeah. So now you know, what happened to us is we pulled our foot off the gas, as you know. We did actually end up buying 3 deals during this period of time, and we refinanced some deals. And that actually proved to have a little bit of pain, to, you know, just like everyone. So we weren't immune. You know, our company is not immune to anything. But we didn't load up. We didn't buy 20, 30, 40, 50 deals during that 3-year period. But we did do a little bit here and there. And why would we do that? We did that because we had loans maturing, we had stuff going on, and we had properties. We had one property that was older, and the loan matured, and it needed, you know, a rehab, right? Because we'd owned it a long time. And so we put a floating rate debt on it while we were rehabbing, and rates went up, right? So all these things can happen. Now, this is a property, thankfully, we had owned a long time. And you know, so the point here is that, you know, we also felt the pain just like everyone else, but we didn't buy a lot. We didn't syndicate a lot. And our deal was not, next year is going to be worth a lot more. All of our deals are longer term holds. Like we have lots of properties that we've owned over 10 years. And we're not in it for a short term. We're not trying to flip. We're not trying to time the markets. We're trying to utilize the tax laws that are available and legal, like cost segregations and bonus depreciation and regular depreciation and you know, all the things that you get in addition to the cash flow and using the debt and all that kind of stuff. So that's the game. And every time you exit, what happens is you pay typically a tax, and then you have to roll that if you're doing a 1031, you can possibly roll that again. But then what happens is, you know, at some point the market peaks. And so the game is, in my opinion, to create the value during this period of time through really, really good, deep operations. And so what happened here, and from my experience, it's actually started in 22, 23, and 24, is this is when the syndicators started to actually take a look at what's happening. Like, you know, seriously, I'm out of money. And they started firing property managers, or they started managing the property themselves, or but how do you manage a property when you don't know how to manage a property, right? So, you know, maybe they were just really good at raising money, but when they walk onto a site or a property, they you know, they know it's there, but they don't always know. I mean, they're getting schooled by the management companies that's there, because, you know, they're professionals. And so what you saw during this period of time was a lot of finger pointing, right? And it's never, of course, typically at the person that put the deal together. It's usually at the management company. But also during this period of time, there's a lot of money that people ran out of. So they ran out of reserves. They had no cash flow. This is a cash call period of time where they're doing cash calls with their investors and all that kind of stuff. And some of that was done extremely well, and some of that was done very poorly. So there's in some cases, extremely good communication to the investors, and other times very poorly. So we were hearing all kinds of stuff. And so during this period of time, I was like, okay, it's still not time, right? We're in this period of disruption, and it's still kind of going on a little bit. And so what happened during this period? We focused personally on operations. And so how can you focus on operations? Now, let's don't forget what's going on with inflation. So we're getting whacked on our landscape costs, on our utilities, on our property taxes, on our insurance, on our appliances, on our carpet, on our paint. Anything that we would do on our 10,000 units was trickling through because inflation hits everyone. So if a landscape crew has to pay their team more money, they have to charge more. Same thing with painters. If all the stuff all the disruption that happens to get something, like paint into the U.S. or whatever it is, the components, all that stuff went up, and you guys all know, where all that went. So this was a time where we were like focused on operations because we have never seen in the history of our 25 years of a more aggressive price increases all across the board, especially with insurance. And so this was a time where we said, okay, we can control the top line. We can try to stay as occupied as we can. This is not a time to push rents. This is a time to have high occupancy and get high cash flow. But this is a real time to really focus on the cost. And so we hired a full-time person for procurement in our company. And they went through all the contracts, make sure, all our prices were correct. And this was a several-year project during this period of time. But that was their full-time job, just to look at the operational expenses and try to drive the costs as low as we could during this period.
Yeah, I think this was also a telling time of who the true operators were versus the capital raisers. And you're a true operator during this time period, doing everything you just said. And what I think was important, one of the secrets that you were mentioning is about how do you basically read the market or read the tea leaves before everybody else, in a sense, right? And what indicators you were looking at that led to you guys doing all this. And what's interesting with from my perspective, right? I was watching YouTube, I was watching stuff, but I wasn't really sure when something was going to spike. But all of the real investment advice I've gotten has been one-on-one, has been talking to other investors, finding out what's actually happening on the streets, and what's actually happening with real operators like you, other operators that I know that and so forth. For me, single family, I know a ton of single family operators. What are they actually going through? And those conversations, to the point at the bottom of the slide, really happened in private rooms. They didn't happen in YouTube. They happened on the phone. They happened, they happened by, hey, you're looking at the federal funds rate, right? I'm like, cool. What slide is that? How do I look that up? What is that? Right? You're sharing it with me. And from my experience, even watching YouTube, besides your channel, Ken, I actually do watch your channel. You're the only channel I actually watch. No, don't let that get to your head. But besides your channel, a lot of people are doing hindsight stuff, right? They're not looking at actual real progression, or they're just trying to get clicks and views, in a sense. And so, point being, 15 plus years of experience, 30 plus years of experience. I think most of our investment advice and ideas and concepts come from interaction with other investors and seeing what's actually happening and watching what you're reading, what other people are reading and sharing it with each other. You know what I mean?
Oh, I completely do. Yeah. And also, I think a lot of times there are a lot of mistakes that were made, and and certainly we make them too. Like we make mistakes in every cycle, going up and going down, right? And you don't really learn a lot when the market's going up. I mean, you can't really talk to anybody when, like you said, like they're flipping and flipping and everything's working. They're really
Yeah.
not listening. They're not listening because they're like, listen, it's working fine. I'm crushing it. And so it's the same with multifamily. And so nobody really listens until they have to. And,
Well,
and
yeah.
then then really that's when the pain sets in, the lesson begins. And if they're really being honest with themselves, you can go back and actually see multiple things that were mistakes that were made, fixed rate debt being one of those, overpaying being another one of those, not doing their due diligence being another one of those, not understanding how to manage a property being another one of those. Like there's all these things that are so obvious to me that people were doing because they could capital raise and buy things, and they did. And so all that's starting to show up. And so what happened with us is the only real issues that we had were loan maturities, and they still happen. I mean, we've got a few this year, we've got some next year. So loan maturities are a real thing. So when loan matures, then that's when the rubber hits the road. That's when the lender steps in and shines a light on your asset and says, "What's it worth?" Oh, it's worth less than the loan.
Yeah.
You have a problem, right? But you can mitigate a lot of that stuff. And the only way to really do that is to have a team that's experienced and has been through it before.
Yeah. And for those of us that are out there still learning this, it's like, who do we call when we don't know what to talk to and who to meet? And I think that comes from, I'll plug Limitless Expo, and I'm plugging it, Ken. Right. And so I know this is about what you got going on, but when this was all happening, when you showed the federal funds rate, when you called me, that was like a month before Limitless. And then at Limitless, our first Limitless we ever did in 2022, right? You were bringing these things up, but there were people on stage
Still buying.
still buying. And I
Yeah.
remember you going like, okay, kind of.
Well, I remember
Right.
just being funny. Like I won't mention who, but
Yeah.
at that first Limitless that you and I did, there were, I don't know, 4 or 6 syndicators raising capital at that event. And we had already taken our foot off the gas, and I was like, man, this is they're going into risky territory. Now back then I could have been wrong. I didn't know, like obviously, but for me, those red flags were there. And I said, I just don't feel good about taking 20 some years of investors and experience into this cycle. I've seen this before. There's and that's why a lot of people set these goals, and I get it. Like I want to buy X amount of units a year. That's awesome, but it's not necessarily always realistic because, there's for sure time frames, just think for anything, that you should not do it.
Yeah.
Like period, right? And so the hardest part is the discipline and seeing when you should not do it. So
Correct.
that's all. And so there's a time to buy and a time not to buy. And just like anything, it's not always a continual time. And so, that's essentially what we did. And that's why our portfolio, by the way, our portfolio has absolutely adjusted down in value, just like everyone else's. The difference is I'm fine because I don't have loan maturities and I don't have these big interest rate adjustments and all these things, and has it been painful? Of course. Yeah. We have our own internal stuff too. But thankfully we didn't load up, in that couple year period, like you said, that
Yeah.
we saw people doing it.
Yeah, and we also, I not deal with, because of Limitless and because of other things we do and some of the stuff we do, we have our events business. Great. I have a hard money lending company. So we talk to a lot of on the street investors that are out there. And I think one of the things that, at least in my seasoning of doing this business, is because of social media, because of YouTube, and because of, it's almost like this FOMO, like I'm supposed to go buy. I'm not doing well unless I'm buying more, right? Bigger is better. And sometimes that's a concept I think that's hard for people to grasp in this business, is what you just said, which is it's not always better to buy. It's not always better to be bigger. It's not, more is not always good, right? And what I try to explain to other people, and you and I've talked about this, like if you're in a career for 20 years in real estate, 1 or 2 years is just a little piece of that career in your investment portfolio. And, I didn't buy anything in 2023 at all, right? That was actually kind of hard to not buy anything in 2023, but I'm happy I didn't, right? So that's kind of my advice to some people that are watching this, that like, maybe right now is a good time, but it's not always a good time, and bigger isn't always better. And I think that's what hurt a lot of these syndicators, was that they bought, they made money, and and they think, if I keep buying, I'll make more. If I keep selling, I'll make more. And it's never going to stop. And I remember, to your point, you said people don't make money. Sorry, people don't learn anything when they're making money. There you go. That was what you told me that on July and 4th of July when we were on the at our friend's house. And I'm like, oh, that's so good. I didn't learn anything when I was making money. So
Yeah, it's true. But
people are
you
learning a
really
lot right
think
now.
your ego just gets a hold of you and makes you
Correct.
believe that you're, invincible.
All right, let's on with the show. Right. So continue it. So that's Ken. Secret number 2. Why did you
Yeah.
deploy $500 million, half a billion in 2020?
Yeah, so there's obviously so the story up to this point has been interest rates came down a little bit and a huge price correction, right? Okay. So now let's take a look at the single family side of the equation real quick.
Yeah.
For whatever reason, single family zoomed up to in the mid 4s, and now it's hovering in the low 4s, let's say, on a national rate. So single family home prices have a lot to do with the rental side of the equation. So it's something that I really pay attention to, because when everybody's doing these YouTube videos and saying, single family is going to crash and all this stuff, and I'm like, well, we weren't even at 1 million listings, in 08, that we were at 4 million, and that's a crash. So, and doesn't a crash mean like defaults? Like, where are the defaults that, so there were all these things that people were saying and I just wasn't seeing. And so, what's happening is the single family market is normalizing. It's no longer a seller's market, right? And there's nothing wrong with that. I think that's healthy. And so I think when I looked last, we had 1.1 million listings, which is like a 3-month supply, which is about normal. Now, could it go more? Of course, right? But there's no crash there. And so why is this all important for me? It's important for me because if interest rates are still in the 6s and the average price of a home is in the 4s, you're looking at a good $2,700 a month mortgage payment-ish, somewhere in there, and where rents are on the national average around $1,700. Okay, so the $1,000 gap is important. I watch that gap, right? And so I want to buy in markets where that gap is large. And so will I be watching single family? Of course, but single family, if people can move from rentals to single family, they will. And so I started seeing all this stuff, and so the price of single family has actually kind of held in spite of even these rate cuts, the Fed's done, and all that kind of stuff. So I'm sitting there going, okay, so if you look at the home ownership rate as compared to the renter rate. So the home ownership rate in the United States is 65%. Now, while that doesn't seem like much, it's a 65% of 133 million people. Okay. Now, on the other side of that, 35% are the renters. Okay. And so there are more people moving or staying in the rental side. As I've talked about, this is becoming a renter nation. Mm-hmm. So there's an affordability problem as a result of the single family home price kind of being propped up. And so what does that do? What that does is it keeps somebody in the rental side of the equation. Now, I actually don't think that's healthy. We don't want a renter nation. We want, in my opinion, what's supposed to happen is when you're young, you build your credit, you move into a rental, and then you save some money and you buy an affordable house, and then you build your equity, right? And so because if you're a lifelong renter and you have inflation, it's basically a tax to you. And if you're a lifelong homeowner and you have inflation, it's basically like a paycheck. So, it's so getting into a hard asset is extremely important. We do not want a nation of renters, but as of now, we have this affordability problem. Okay. So what does that mean for me? Until it gets fixed, and the only way, in my opinion, it can get fixed is if we flood the U.S. with additional homes, create more supply because we're severely undersupplied, and or really jack those rates down, and tap into all that $46 trillion of home equity, which could happen with this administration. But in the meantime, we have this resistance between the renter and the homeowner, and so renters right now have the upper hand. They have the upper hand because we added 500,000 multifamily units to the nation, to the U.S. In the last 12 to 14 months. Okay, what does that do? That floods the supply of units into a market. And what that does is it creates a massive advantage to the investor. Creates a massive advantage to the renter. So here, what we can see is a bell curve, right? And this is very common where you start to see the recovery, the expansion, the market stability, which is what we just went through. Then the hyper supply, which is where we're at right now. So we're at the hyper supply spot. So how the hyper supply, the units that hit the market, the 500,000 units, that started in 21, 22 with lower interest rates. So they're hitting the market. So the renter has the upper hand, and we're moving to the oversupply stage. So hypersupply and oversupply drive prices down. And so prices are coming down, interest rates are coming down. I'm looking for cash flow. And the flip side of that is now when all that gets absorbed, just like it happened in, remember I made the example of 2008 when all the people moved from the home ownership side into the rental side. Well, when that gets absorbed, it's going to put pressure back on the multifamily side and the housing side. So when you look at this from a macro standpoint, it's clear that right now the renters have an upper hand. This will get absorbed because they don't have another choice, and these units will become higher occupied. The concessions will start to go away. Then you'll start to see rent growth. And then what's going to happen? People are going to jump in again, and it's going to push the prices back up again. And so the time to buy is right now where you see the number 4 here on the screen. And so we went through hypersupply, and now we're at oversupply. Now that's oversupply as compared to demand. And so this is the time to be looking. And you can very easily get hurt here too. Like you can overpay here. Oh, yeah. And so what we did is we started looking for assets at the end of 24, beginning of 25, and our team did a masterful job of buying, and we started some new construction. We did some refinancing and all of that stuff. So, we turned the car back on and we got the engine going down the road again. And last year we did $528 million worth of transactions.
It's crazy. And I think I will push back on one thing you said, right? Just listening to you. I've been meaning to say this because I listen to your podcast and stuff like that. And that's like, where you brought up the listings, like, hey, we're only at 1 million something. We're, just nothing. I agree with you on that. But I think there's also very specifics when you add in this chart where like it's oversupply based on demand, right? And in where I live, right, is Austin, Texas. There's not tons of listings, but there's also no demand, right? So it is actually affecting the market here locally, right? Which is good depending on what side of the coin you're on. And whatnot. So even though the listings are low, the demand isn't making it to where it's like it's making it because it's oversupplied because the demand isn't there. What I'm seeing.
But you're right. Actually, Austin is a really rough market right now.
Yeah.
But here's the counter argument to that.
Okay.
So, if you are right, if you don't have the demand to be able to buy single family houses, what that is doing is keeping people in the rentals. And that's kind of my point. Yeah, like so
Now
you're
there
right.
is an oversupply of rentals here, which is
Well, yeah, because they
incredible.
overbuilt
Yeah,
Austin
they
on
did.
that side of
Yeah,
it
the
too.
hyper
Yeah.
supply, right?
But Austin is a good market to look at because overall there still is growth in Austin, just not like it was. And so going back to, one of the things that we look at is we look at migration patterns of people. So
Next slide.
you start to take a look at the rate of population change. So obviously the dark green shows a population gain of 4% or more. So why is this important? Because if you're in the red areas, let's say, you are not happy right now because of you own something there. Maybe it's a restaurant, maybe it's a multifamily, maybe it's a home. It doesn't really matter, but you can kind of see here. Now, this is all done through the Department of, I think it's BLS, Bureau of Labor Statistics. Also, driver's licenses, out-of-state driver's licenses. The U-Haul, North American Van Lines. They all have data where people are going, cell phone data, all that stuff. You can kind of figure out where people are going, and they're going for all kinds of reasons, right? So if you focus on the areas that are green here, you can actually kind of direct your capital there, right? Mm-hmm. So like if you look at Upper Washington all the way up in the left-hand top left side, that area is Idaho, Spokane, right? So as you guys know, that's Boise. Most of Idaho's been on fire, right? You go down into Nevada, you can see that's Las Vegas. And so you can kind of see, and why is this important? Because, Tarl, no people, no rent. Like, you know what I mean? Like,
yeah.
Like if people leave, like your customer's gone. If people come, then it puts pressure on the existing infrastructure. It's really that simple. So, if we have 50,000 or 100,000 people moving to Phoenix, let's say, or more, well, what does that do? Well, it puts pressure on rents. It puts pressure on home prices. It puts pressure on the schools. It puts pressure on the restaurants. And the opposite is true too. So as people move away, we've seen that. We've seen, like, the Detroit is probably the best example in this last century, where it used to be the 5th largest city in the country. And why? Because of all the jobs and the automobile manufacturing, everything, and when that all got moved and redeployed, that city took its lumps, right? And for years and years and years. And what happened? The home prices went down, the rent prices went down, the defaults went up. So this stuff can be regional, like in your Austin example, right? Mm-hmm. So if you're in your bubble of Austin, you're looking at it from an Austin point of view. If you're looking at it from Phoenix and just there, then that's your point of view. But as you can see here with this chart, things are very different all over the country. And so the cool part about real estate is I can be in pain somewhere, but I can go to an area that's actually trending up, right? Because it's not a national market. And so that's why I wanted to talk about the population change, because the population change is significant. I don't want to get too far into the political environment and the safety environment, but I know personally plenty of people that have moved out of areas, and I'm from the Northwest, right? So I spent a lot of time in Seattle and a lot of time in Portland personally, grew up there, and I have friends that won't even go into the city at all, right? And they haven't moved out of the state. Some have, but the reality is as those cities figure this out, maybe those are good buying opportunities, right? Because I do believe at some point they'll figure it out. But at the end of the day, this is what you look at when you're buying real estate. You're looking at distress. And you're looking at opportunities. And so if a business moves from a state because they don't like the taxes, they don't like the government, they don't like the whatever the policies or whatever, or rent control or whatever it is, or they can't attract new employees because the cost of living is too high. Whatever it is, that affects that state and it helps another state. So these are the things that you have to look at when you're investing.
Agreed. All right, let's keep going. Let's look at Las Vegas.
Oh, okay. So this is a very interesting. So this is one of the markets that I'm looking at, and I think it's important that we already bought stuff here, and if you go up to the upper left corner where it says development, and by the way, I'm just picking on one market because I wanted you guys to see exactly what I'm looking at when I'm trying to find something. Take a look at the development. You can see there's a sharp decline in development. Okay, so that's huge. Because what I always want, Tarl, is I don't want to buy in a market that's overbuilt, right? Like Austin. Austin's a great example of a market that's overbuilt. Oh. You're going to see a very different chart.
Dude, yeah. I mean, like living here, right? They just got done building probably a 200-unit apartment complex like 6 months ago. By they, who are they? I don't know, some guy. And still not filled. They broke ground on another 200-unit apartment complex. Half a mile away, right on this road, in this area where nobody, it's like I live out in the country part of Austin, and there's another one being built. I'm like, those guys started a long time ago. They had to do this, but like all the A classes here are just giving 3 months rent free. Like it's just overbuilt. So anyway, sorry, confirming.
Yeah, no, it's a heck of a point. But this is a really interesting point because, by the way, it doesn't mean that Austin's bad.
Yeah.
It just means it might not be a good time to buy now. Right. So when you look at Vegas, you can clearly see it peaked, a while back, and now it's on its way down. So and by the way, I want to say that was like 6,000 units or something is all. So, once again, what do? You look at where are those units being built? Southwest, Southeast, Northwest. So it doesn't necessarily mean that Vegas, you should write it off. In fact, in this particular case, the low development is good. But what you have here is you have a disproportionate number of units that were built in different areas. And so it can create softness in one area of town and the other area of town might be great. So this is just one indicator that you want to look at. And then as you move over to the right, you see the net absorption. Now that's a people issue. You can see the negative where it went below. That's not good. A positive is good. And that just shows, and it reflects to the other one to the right, which is asking rents per unit. And you can see how it peaked, how it dipped, and kind of where it is. It's flatlined right now, as I said. Okay, so what we have here is we have a situation where you got a municipality that's actually growing in people. And it's growing for all kinds of reasons. Like you think of F1, UFC, the movie business, people that don't want to live in California because this is their neighbor. Whatever it is, people are moving there. Great place to retire, pretty affordable, all kinds of stuff. Is it my number one market? No. But it is a good market that is trending positively. It doesn't rise and fall on casino business like it used to. By the way, I used to live in Vegas. I understand it extremely well. And so this is part of the reason why I like it. But now you're looking at the rents and they've flatlined. Not a bad thing if you're buying. What you don't want to do is buy, when they're spiking up because the sellers are cocky during that period of time. So now let's go down to the bottom left, which is occupancy. Obviously, that you want higher occupancy, right? So again, this is Vegas, the whole market. And so occupancy peaked, dipped, and now it's peaking again. And the vacancy rate went up again to the right there, and it's obviously on its way back up and flatlining at least. And by the way, that's not necessarily a bad vacancy to buy at. And then, of course, on the investment sales side, you can kind of see all of that reflected in the other charts. And so when I'm looking at a market, I'm looking at all of these things. And this is what I might look at before I even fly there.
So I want to stop for a second. Kimberly had a good question. Like, these are all 2024. I want to clarify for Ken's benefit. Ken was looking at these during that time period to invest.
I bought in 25, by the way. Yeah, I actually specifically bought these up for 24.
Yeah, so these are specifically because Ken bought in 2025 in
Yeah,
Vegas. That's why we're
correct.
looking at the
That's
data
right.
you
Yeah.
looked
So
at.
really, really good
Yes.
point to make. And so obviously those are going to be different in 25 for sure, right? But we deployed capital, bought units in Vegas in 25. And it's a market we're watching, right? And so, which is really a great segue for, I had a deal in escrow there. I won't name the deal that we ended up not buying, right?
Oh, we're gonna get to that in a minute. So
Okay. Oh, so
you
we'll
got a
get
couple
there in
more
a
shots. We
second.
can blow
Oh,
through. If
wait.
you don't want to do
Hey,
this,
look at that. Oh,
yeah.
look at that. There we are. We're number 2, Alta. So that's one of the deals we bought in 347 units. And there's what we paid. And MC Companies. So that's our company. And so this is data that we were looking at. And this is data, as you can see, during that time frame, guys, there wasn't that much going on. That's not a lot if you really take a look at it, right? And so, we felt like we got a really, really good price. We love that project. It's a fairly new deal, and I think it's like a 2022 or 2023 construction. And it cash flows and it's highly occupied. It's near a Whole Foods. It's in Henderson, Nevada, and turned out to be so far a very, very good deal for us.
So that was pretty much a brand new build that you bought.
Yeah.
Yeah.
Mm-hmm.
That's awesome.
Yeah. Yeah. And then I think, the reason we brought this up, Josh and I were working on these slides yesterday. I just thought it's funny. These are a couple of YouTubes that we, I really look at this gal up top. We won't increase rates until interest rates won't increase until 2023 from some economist. And that's just not true, right? So we went back and we're taking a look at, as you guys know, interest rates went up in 2022, and the same thing in 2026, and so. I know Graham, of course, he does study this stuff, but him and I was on his channel. I don't agree. I just don't think home prices are going to crash. I'd love to know your perspective on this, Tarl. I don't see, to me, a crash. I went through 2008. A crash means people can't pay. Banks are taking over their places. That's not happening. And so if somebody thinks a crash is 420 to 405, then they're probably right.
Yeah.
But, a crash to me is significant. It's a huge price reduction. And I just don't see it. What do you see?
Yeah, I think it's all semantics, right? And also what you consider on YouTube to get somebody to watch something. But I think that it's just like anything, there is no national real estate market. There's just a whole bunch of real estate markets, right? And I think it's very specific to that market. And I think that it also, I don't know, dude, real estate's so personal for people. And if I'm thinking about it as a single family, and it is emotionally driven for people in single family, I'll give you what would feel like a crash for somebody. So feel like a crash would be, let's say somebody bought a home in 2022 when it was a new build, right? A new build home in the subdivision. And yet that builder still builds a whole bunch of more new homes between 22 and now. And those homes are on the market, right? Where you're in a subdivision and you're going to try to sell your home right now. You're competing against a whole bunch of new homes that a home builder is giving 8, 9, 10% concessions on. And you're going to sell your home for less than what you bought it for. Like, I think individually and market specific, it could feel like a crash, even though we look at it as a macro level going like, that's not a crash, right? And so, but if somebody's losing money, they think it crashed. Right.
Yeah.
So you know what I mean? So
yeah, pay no attention to the fact that they bought it as Airbnb and it doesn't cash flow now.
Let's
So,
not talk about
to
that.
them, that's a crash. Like, I experienced a crash in 2008. I know what it feels like. I watched it. This is not, there's nothing, we're not seeing price reductions like that. And we're not seeing listings like that. And, there are price reductions. Don't get me wrong. There are areas that are extremely soft and are definitely pulling back. Austin is one of those.
Yes. I would also say that part of it is this, like I said, dude, macro, I'm on the same page with you all day. The individual investor that's on the streets, there are plenty of them out there that feel like their world is crashing right now. especially if they bought over the last couple of years. And to them, they're feeling like it's a crash in single family. I know house flippers, but they're because they bought and then the market didn't go what they wanted and they betted on appreciation and they just did bad buys. Does that mean the market crashed? No. Does that mean it is crashing? No. That just means they think it is, right? If that makes sense. So that's what I believe, is that you're going to have people feel like it, but even though macroeconomically it's not. So
yeah. I just saw a comment. 4.82 cap in a 7 cap environment. It's not a 7 cap environment of Class A. Trust me. So, that's somebody who is not buying Class A. So Class A is not even close to that.
Yeah.
Maybe you get a C there, but why would you buy a C today? The reason C's 7 is because A's have concessions. Like, so you can be a B or a C and can live in an A. Why wouldn't you? Right. Based on the concessions today.
Yeah. And then I will also say this, just because this is Austin, this is definitely Austin. Just because somebody listed it at 750 and they dropped the price to 650 doesn't mean it was ever worth 750 to begin with, ever. Right.
Yeah. So that's another really good point. Yeah.
There's like, I'll give you, I looked at one today. I bought a duplex in my area for 440 about 4 months ago. Right across the street, the person listed their duplex for 750 and it's the same property I got. Right. There's zero. And that property I bought sat on the market for 8 months. Like, that price is, there's no way that place is going to, it's going to.
So when they lower their price, somebody on YouTube says it's a crash. Yeah. Correct. And that's kind of my point. Like, it's subjective. A crash is not a personal experience. Like, you know what I mean?
I know that.
It's not, it's a market experience. Right. And so you can't have a crash unless you have defaults, period.
Yeah.
And somebody's going to say, well, there are defaults. Yeah, but there's hardly any, and we're so far from that. I can't even believe we're still discussing it.
Well, part of it's also way you play statistics, right? So if you have, like, historically, the last 4 or 5 years, defaults have been historically low because their market has gone up so much. So when you go from 1 default to 2 defaults, that's 100% increase in defaults. And you can placate that on YouTube. You can placate that on news articles and everything all day. 100% increase in defaults. Well, you went from 1 to 2, right? So that's what is actually
1 to 2.
Now they are going up. Defaults are going up, right?
For sure they are. Yeah.
But they've been historically low. Correct.
They've been historically low. And don't forget, let me tell you the big difference of 2008, having gone through it.
Yeah.
Today we have 46 trillion with a T in equity sitting in people's homes because of the price increases. There's so much equity people are sitting on. Correct. That did not exist in 2008. Like, if people had equity, they would have been able to pay off their loans. The real crash came at the bank level. Yes, people lost their down payments, but we're not even close to that. Like, there's so much equity, and that's what Trump's trying to tap into right now. That's really what he wants. There's so much money sitting at 2.5 to 4%. I mean, I wouldn't. Like, if you have a really low interest rate on something, why would you trade it out? So I think what I was trying to point out here is, if you're trying to, you need to get in the right room with the right people, because if you're just clicking on YouTube and following these gurus, you're not going to, be mano a mano, sitting elbow to elbow with people. They're actually doing stuff like the folks that come to Limitless. They're from all over the country, actually Canada, Mexico too. And they're doing things. Like, I was just in Mexico City, and my buddy's crushing it. He's buying these affordable homes and crushing it. Now, I'm not advocating to go buy in Mexico, but the point is, there are people that are doing extremely well right now, all over the place. And if you're just trying to figure it out on YouTube, you're in the wrong room, because Limitless is actually full of people that are trying to figure out, how do I unwind my issue? These 3 things that we're talking about here. How do I figure this out? I'm going to get around a bunch of people that can help me. 2, what are the red flags? And 3, what are the opportunities? And that's this is it. Like I'm telling you, come summertime, there's going to be a lot more stuff, a lot more drama in this arena. Not at Limitless, but certainly in the multifamily and the single family, we're going to have a lot more stuff. The playbook is going to be different,
Yeah.
obviously, in 6 or 7 months, right?
All the stuff we're going to be able to talk. I can only imagine what we're going to be talking about in August with
I
what's
know
going on right
it's
now.
insane, right?
I'm actually kind of excited. And so when it comes to that,
Yep.
and Ken and I, in what was it, this January 2022? Yeah, January 2022, right? Yeah, that sounds right. You and I were at a bar in Laguna together, and we were talking about all this, right? But something you brought up, because you're the genius, right? Was along the lines of like, maybe we should bring a lot of people together to talk about what's going on right now in the world and stuff like that, and that we can learn from, right? And that led to us, literally the next day creating the Limitless Expo so we can bring people together. But what I love about it, even from your perspective and my perspective, is that, dude, all the speakers, the attendees, like most of the attendees should be on stage, basically. Like these are real operators and stuff that are out there.
Yeah.
We've met so many great, there's a lot of friendships you've made. There's a lot of friendships I've made just from the attendees that come, that we just get to meet because we want to be around like-minded people so we can learn. Like, I want to know what you got going on. I want to know what somebody's doing in gold and silver. I want to know what somebody's doing in oil. I want to know, I only know my single family stuff. Like, what's everybody else doing? And that's why I like Limitless. And not just from like the YouTubers, but the actual people you would never know because they're doing the work in the field, actually making it happen. So they're in the trenches, right? Those are the people I want to go meet. So
yeah. And Melissa brings up a really good question. She said, why at Limitless in 2022 did you not tell the syndicators pull back? So what's interesting is we did, and we had a panel. You remember?
Yeah.
Like I was up there saying, this is what I see. This is what I see. And what happens is, kind of the point, nobody sees anything when the market's going up. It doesn't enter their brain for some reason. They're like, rinse and repeat. Next year's going to be, I don't agree with you. Next year's going to be better than this year. So I don't know why, but the reality is that is the point of Limitless. It's extremely transparent, and people are very authentic with what they see. It's not we're not holding things back in any way. The whole point of Limitless is to say, what are you stressed about? What's happening? How can we fix it? We're in this together. And the reality is some people walk away and don't do a thing and don't agree and just keep doing what they're doing. So for that, I'm not sure why.
I would also say, like, because, going to Limitless every single time we do it, like we also give people the voice of what they're doing, right? So there are some people that say like, no, I think this, but there's also a confirmation bias that kind of comes sometimes with success. And when the market starts to trip, sometimes we don't want to accept that the market's changing. Like, and I'll give you an example in single family. During Limitless, right, we met a handful of people, and I was with them about a month later. There's one guy that was a big house flipper, right, as an example, who was breaking out his business to me. And I'm like, bro, you need to get out of what you're doing. And he's like, no, I just need to get another deal, right? Yeah. That was the answer. He was living in a crash for himself and his business. And his answer was, I just need another deal and it'll fix it. There were so many syndicators during that time period that felt that same way. I'll just get another one and we'll make it up on the next one, right? Yep. It's like a dollar cost average play, but sometimes that's not the answer, right? Yep. And this gentleman that I'm thinking about, 6 months later, like, lost everything, and then he was looking for a job, right? I mean, no offense to having a job, but literally lost everything, right? So, but he was in denial, and he's just like, just to get another deal, and it'll fix itself. So, anyways.
Yep. I know. So I don't know. Like there's a really astute question that was asked, I think, but we don't have a crystal ball either, guys. All we're trying to do is fill the room with people that are doing their thing, right? So the gold and silver, I just saw something pop up on that. We've got multifamily folks there. We got self-storage folks there. We got oil and gas folks. We got people doing timber, water. There's all these things that people come to the room and they're working on. I love to be around those folks. I love to sit around and tap in. Like, what are you seeing? Like, what's going on? And, because it's really, really hard to know everything about everything. And I'm just in my little multifamily lane. So for me, that's kind of why we created Limitless and the only thing that I could really speak to is what I'm doing. I mean, other than that, everything else is just an opinion, right?
Correct. And on that, like, let's talk about what you're watching in 2026, because this they answer the question, like, what should you do now as an investor to prepare and protect your portfolio? But you got some lessons here, and a deal you killed that I think is a really good lesson to learn from as well. But what
Yeah.
are you watching for in 2026? And do you want to jump straight to the Vegas one, or you want to keep talking about, or you want to hit on something else first?
Oh, no, this is fine. We'll just
Okay.
jump in here. I think the reason why I put this up here is because hopefully you guys can imagine, I'm trying to buy deals. I'm underwriting them. We have 400 people. We have acquisition guys. We have analysts. We have people, flying out me with brokers. We're looking at rent rolls. I mean, we're making very calculated, good decisions on things. We put a deal in escrow, and the toughest part about this one, Taro, I haven't actually told you this. It was a 1031.
Oh, the Vegas deal?
Yeah.
Oh, this is not the Vegas deal, but this is what it could look like. Imagine you're.
Okay, so a 1031. So we had a property we sold, and this was one of the deals that we had in escrow, trying to buy. Okay, so I had the equity.
You just killed this, by the way, right?
Yeah. So okay, so why would we kill a deal? Okay, so especially when you already have the down payment, like, right?
Yeah, that's a big deal.
Okay. Well, what happened was we ended up, we loved the area, and the property was fairly new. And what happened was when we first put it into escrow, the property was at 92% occupied. Then it went to 90. Then it went to 88. Then the concessions went up from 1 week free to a month free to 6 weeks free to 2 months free while we were in escrow. So why is that a problem? Because you're trying to buy it, obviously, when it's full and not have all those concessions. And so the income was trending down while we were in escrow, while we were doing due diligence. The property management company and the ownership was having a heck of a time keeping it full. Now, that could be a market issue. It could be a property management issue. It could be there's too many units in the supply. Could be temporary. Could be long term. Could be employer left. There's all kinds of reasons why that could happen. But I'm not going to go into any of that. The reality is the income went way down. Okay, so now let's move to the debt. So if you're a lender and you're lending on something that was 92% occupied, not a lot of concessions, and your income number is whatever it was at the time that we brought the project to you, and you gave me a debt quote based on that, and just in a period of several months, that changes a lot. What are you going to do? You're going to say, I can't lend that amount, right? I have to adjust my loan. So my loan balance, or my loan that I thought I was going to get, went down too. Not necessarily the rate, but how much debt I was going to use. So now I'm at a fixed price. My debt amount goes down. So what does that mean? That means my equity has to go up.
Yeah.
So now I either got to have the owner reprice, or I have to put more money down. But if I put more money down and I get less loan, that means that the deal's probably not going to be as good either, because now I'm dealing with the operational issues and I got to fix that. So the lender's skittish because the occupancy went down and now we got 2 months free. And so these are the kinds of things that can happen when you have things in escrow. And why was I able to kill the deal? And I'll tell you, one of the biggest lessons is I did not put what's called hard money down at any point, because I'm like, I need a free look. at the property, and we want to make sure that all the boxes are checked and things check out financially. Well, if I would have had hard money down, and this is one of the mistakes people made during the run up, is they were putting $1 million down, $500,000 down on deals that they weren't even so they would have been, they literally would have had $500,000 or $1 million in this deal at this point, and they would have had to move forward.
Just semantically, for those of you single family investors and people, when he's saying hard money down, he's going hard on his earnest money, which means he's putting earnest money down and basically letting the seller take it if he walks from the deal. So just to be
and that happened a lot too, by the way, during that run, right? And
there's people we know that had $1 million hard that bought the deal because they didn't want to lose the $1 million. Correct. And now they're underwater 40 million on the deal.
Yeah. So because they made the one mistake of putting $1 million down to get a deal. And if you're the seller, that's good for you, because if you walk, you get the $1 million. And so in this particular case, we're like, hell no, like, I'm not going to do that. Like, we need to really make sure that if, because we have the equity, we want to make sure that this all checks out. And what happened was the operations got worse while we were in escrow. The lender said, we're not going to be able to lend as much because the operations is worse. And then, so now we were faced with having to raise more money. And all of a sudden the deal started to not make sense. And so painfully, Ross and I walked away from this deal, even though we had 1031 money, and we made the decision to pay tax. So rather than buy something with money we already had, and continue to fight a battle, because the question was, how long will this last? 1 year, 2 year, how long? 3 years? We don't really know. Or maybe you're better off just to live another day, pay tax, have the cash, nothing wrong with cash, and keep looking for deals. But it hasn't happened to us in a long time where we actually have had to pay tax on a 1031. But this again goes back to discipline. When you could buy something, you actually literally have it in escrow and you have the equity, and you back away, that was, I still today believe that was the right decision.
That's great. Yeah. I remember, basically, so everybody, just to summarize, what I'm hearing from Ken is that he had a deal in escrow. While as an escrow, it lost value, right? And it wasn't because it's based off of cap rates and NOI and net operating income and all that great stuff. And the lender wouldn't lend as much. And Ken has to say, do I put more money down? The deal's going south. So that lesson, though, like, not a lesson, but did that change how you're buying anything? So like the fact that you killed a deal, you paid tax, which means that was a really important decision, right? To have to pay that tax. Additionally, like, at Limitless last year, we had a whole session that I wanted to call, it was your session, called I Was Right. Like, Ken was right. That was like, that's what I wanted to call last year, Limitless 2025. And Ken did a whole thing about multifamily and how he's buying and all that stuff. And if you would have talked to me or anybody else in 2025, Ken was right. He's buying a bunch of deals. He's going for it, right? Cool. But you killed this one. Is that because the market was going down? You still think there's more to go? Like,
We did. I left out a key thing. We did go back to the seller and say, listen, you, not us, have dropped the performance, and therefore the value's down, and therefore the lender's going to lend us less. So we need a price reduction, and based on how you are running your property. And they said no. So so the reality is you back away from that. Do I like the property? I do. It was a great location. Is it still going through pain? It is. But so what you would do is you just let the market reprice it. And when we first went into escrow, things were different. And when we got out, they were different. And so the lesson is, be careful not to trap yourself into something. And also, it's like know when to walk away, right?
Yeah.
The Kenny Rogers song, right? Like know when to hold them, know when to fold them. Seriously, you have to. It's part of the game. And just because you have the debt, just because you have the equity, and just because you have to close, you need to be diligent with the investment.
Love it. All right, so let's get going then on what are your actual 3 warning signs that you're watching right now.
Yeah. So why I like, here's what I like about this. This is Real Page, by the way. You guys can take a look at this. This is a one of many very good things. And so what you have there are obviously the apartment supply. And what we're trying to do here is, you guys can see the apartment supply, how it peaked in kind of 23, 24, as we've already kind of gone down, and then you got your supply expansion rate. And so what you see is a big drop off there at the end, that goes down to 25. Um, and so what this tells me is, it tells me that you have a high supply of units that have hit the market that haven't fully absorbed yet, and you do not have a lot of new construction coming. So all things being equal, if you can buy today when things are disrupted, if you can buy today and look at this as compared to the markets going all the way back to 1973. We've never seen anything like this. So you have a tremendous amount of units that have hit the market. Now, for a lot of people, they'd be scared about that. Okay, but the time to buy, the value is now. The value is when there's vacancy. The value is when there's high marketing costs. The value is when the tenants have lots of choices. Is it risky? Of course. But I have the confidence in our management company that we can buy something and keep it full or in the right market. And so you make your money when you buy. And so what high supply and disruption and these debt costs and high, low occupancy, high concessions, high expenses, high debt costs, that's disruptive. And that's when you want to be buying. If you own something, your values have already shifted. It doesn't mean you've lost money. It just is the same thing. Like I said before, if you bought a house for 500 and now it's worth 400, it doesn't really matter if you're going to have the house for 10 years. You know what I mean? Like, so it's irrelevant, but you're looking for these buy opportunities. And I think that it's going to continue. And so this is one of the things we look at is a supply issue.
Well, I think, like, to your point, you said something that, real estate 101 is you make your money when you at the purchase, right? At the buy. So,
Yeah.
and that's coming to, diligent due diligence, having a really good buy box for what this is for everybody, especially if you're newer out there or even seasoned right now, is reevaluating your buy box and what's a good buy box for you in this market. And additionally, so something that I like to explain is that, like, for me, like, I was never somebody that on single family that this was great off market marketer or anything like that to go direct to seller. I was somebody that focused on operations and focused on buying the deal versus sourcing the deal. And so for those of you guys thinking out there for yourself, depending on if you're fully in or thinking about getting in, is that, in my opinion, you either have to get extremely good at acquisitions to where you can buy a deal so well, it doesn't matter if you mess up operations, or you got to get really, really good at operations so that you can so that you know how to underwrite a deal really, really well and actually take it to close. I think you should be good at both, right? But I think most people choose one or the other. And the whole point of that has to do with, like, if you get great at acquisitions, you don't have to be that great at operations, but everybody should be awesome at operations, especially when you're in multifamily and so forth, in that opinion. So I don't know if that makes sense, but that's my belief. So
it does make sense. Yeah. Here's the deal. If you don't see things clearly, then they all look like risk, right? But if you've been through the cycle, you understand the numbers, the economics here, where the rent growth is, where the supply is, where the demand is, all the things that we've been talking about. My lens of risk looks a lot different than other people's, right? And it's from getting the heck beat out of me over the years, right? And also doing it. And so I get there are people here that don't want to make that choice. I completely understand. And really, to me, it's like anything. After you do something a while, you see it a little differently. You see your risks go down. And so there's still risks, of course, but how do you mitigate that? You mitigate that with cash flow. You mitigate that with buying below replacement cost. You mitigate that with really, really good operations. And if there was a lot of units coming, I would not be buying. So if and what happened here is, if you could see in 2020, all those units started, if we go back to the beginning of this webinar, when interest rates were low, right? And when interest rates spiked up, people stopped building. Same with single family. So, so what Austin's experiencing, what Nashville's experiencing, what Atlanta's experiencing, what Dallas is experiencing, or Phoenix, is a result of things that got started a couple years ago. And it's hitting the market today. It's oversupplied. And because rates are higher, there's more supply, it looks bad. But, things are normalizing.
Well, I want to add as well, just for this, especially for the newer people that are out there, is that, and Ken, this, like it's right now in the market. Now you're saying get good at the buy, focus on the buy low, you got to hold. But that only works if you're running a good business, right? At the same time, like you're running good operations, right? And that's my thing. I'm a big operations guy. That's why I keep going back to that. And because we know people that maybe bought a decent deal in 21, 22, but they didn't do a good job at operations at all, which is what actually killed the deal. You said your lens of risk is different, but your lens of risk is different also because you fully understand the operations of the deal. So that reduces your risk, right? As well. And so my advice to people out there, especially I can only talk for you single family people, is that it's not going to feel like a great deal right now at times. And so because depending on how you're buying it, if you're not looking at the market data that Ken's explaining for the single family in first, for the fact that like, hey, I'm buying a deal for cheap. Like I bought a deal in Austin for 220, right? As a duplex, which looks like a good on paper. But to other people, it didn't look like a good deal because they didn't understand the operations and what we're going to do to it and how we're going to, there's all these things. It didn't look like a great deal, but it looked like a great deal to me because I understood construction costs. I understood what we can do to the property. I understood what the city is going to allow me to do to it. I understood that I can add additional units. I understood all these other factors and I know how to execute it. So my risk goes down on that deal. My whole point is that I don't see any hockey sticks. I don't think Ken sees any hockey sticks coming in 2026 as far as like single family or anything like that. So betting on the market's not going to be a good strategy, but betting on operations and getting really good at underwriting and getting really good at analyzing risk and getting really good at your market, right? Wherever you're investing in, and then and getting good at just the business side of this business, I think would be the best advice I can give anybody right now. So.
Yeah, and I'll just add one thing. I always tell people, it's what you see. Like literally, like it's why did that deal sit on the for 8 months, and then Tarl saw something in that deal that I wouldn't even seen. It's because of the space he's in and what he saw, and the. Yeah, but like, so what happens is, like, I always tell everybody, like, if there's a 10-acre piece of land and you're driving by it, a custom home builder sees 10 homes. Residential home builder might see 100 homes. A commercial office sees, a grocery store. A multifamily person sees 150 units, and like everyone sees what they see. And so it's okay. A self-storage operator might see, several hundred self-storage units. And that is kind of the point. That's the point of Limitless. Like you can't see everything. And so when there's something, when I'm looking, I have been around. I've been in thousands of meetings on multifamily, and most positive, not all positive. Okay. And so what has that done? That's made me wiser, more experienced, and helped me and able to see things differently. And so that's actually the competitive advantage going into this cycle. And so, could there be more risks, and could there be things I don't see? Of course. But with experience, you reduce risk.
Yeah. And I think, so we're going to go to the second indicator that you're looking at here in a minute. But you just brought up Limitless as far as, being able to see other things. I was not looking at anything but single family for years until I went to Limitless and started running it with Ken, where, just as an example, like, I don't have time to go become an expert on oil and gas, or an expert on buying a franchise, or an expert on multifamily even, right? I have time for what I run in my business. And Limitless last year, like, we always have gold and silver and all that great stuff, right? And silver was at, I think, $35 an ounce, give or take, at Limitless last year. And we had a speaker there, a great friend that Ken and I know well, and he's just like, silver's going to go up, right? He did this with gold the previous year, by the way. Like, gold doubled almost the previous year, but he said silver's going to go up. So immediately after Limitless, I hit them up and I'm like, I'm going to give you a bunch of money to buy silver. He's like, cool. Actually, no, I said, I'm going to give you a bunch of money to buy precious metals. He's like, what should I buy? He's like, all silver. I'm like, okay. So I gave him the money and he bought a bunch of silver. And I just looked at it now. Sure, it went up to 110, 120 or whatever. It's like $80 spot right now. It's more than doubled since then, all because I went to, not because
1 year, in 1 year, by the way.
Not even 1 year, right? That was
Yeah.
6 months ago, right? But what I'm getting at is not that, like, it's, I don't have time to look at silver, gold, precious metals, oil, gas, other businesses, franchise, how people are running stuff. I don't have time for that. I have time for my thing. You have time for your W-2 if you're watching this, or your business. Limitless opens our horizons to see what other people are doing, and it's an opportunity to go see what other playgrounds people are playing in, what other operators are doing, like, and get at, like, basically, like, to work on my business instead of in it, essentially, is what I'm getting at. And also diversify a bit, right? If it wasn't for Limitless, I would probably own any gold and silver, for instance. I'm happy I do, as an example. So, but that said, I'm not guaranteeing you're going to double your money on gold and silver going to Limitless, but it's worked for me so far.
Or real. The key is just get around people that are, doing it.
No, it is Dana Samuelson, not Mike Maloney, but Mike Maloney is great. But Dana Samuelson, who runs Amerigold, he's the one that said it in 2024 Limitless. He said gold's going to go break 3,000 at the 2024 Limitless.
Yeah.
And then at 2025 Limitless, he's like, silver. And I'm like,
yep,
okay. And both times I'm like, okay, Dana, I'll do whatever you say. And sure enough, right?
Yeah, and it worked.
Let's hope he stays correct for a long time. All right, let's go to your next indicator, Ken. What you're watching right now. You're watching three things. We just looked at your first one. Next thing you're looking at in 2026.
Yeah. So obviously you saw, what this represents are rent increases, rent changes, U.S. annual effective rent change. Now, if you're a renter, the green going up is not good, right? Mm-hmm. If you're a renter and the green's going down or flat, that is good. If you're a landlord, quite the opposite. So it just depends on what hat you're wearing. And the reason I put this slide in here is because when rents started to go down, let's call it by the end of 2023, we'll call it. And of course, there's a whole chart for 24, and it's basically flat, and 25. What does that do? It basically takes all the value add plays out of the market. It takes any kind of, any real like story, and this now you're going to get into asset preservation at this point, right? Now, this is not necessarily a bad thing, but this is what made everybody's ego so big. Is, oh my God, I bought in April of 21, and by April 23, my rents had gone up a lot, and look how smart I am. And it's just a market timing issue. And so what happened is rates went down as a result of the higher supply. More supply, renters have more choices, rents flatten, they decline, or whatever it is. So the reality is so this is another indicator. What I want right now, Tarl, is I want to buy during a time where rents are flat or even negative, or there's concessions, because who's selling? The people that are trying to fill those units, right? I have no problem stepping into the shoes with my management company and weathering the storm. The question is, how long do I want to do it? Yeah. And so this rent change is a big one for us, because we believe that the time to buy is when there's not aggressive rent growth, because when there's aggressive rent growth, the seller's expectation is higher.
Yep. And you look like a genius. That's same with single family. All right. Let's continue. What's the last thing you're watching?
Well, okay. Now this is inflation, and of course you've got the shadow stats, which if you guys don't know what that is, it's phenomenal. There's a whole website called Shadow Stats that you should take a look at. But basically, this is a CPI against that, and essentially, Shadow Stats says that things are a lot more inflationary than than we thought. Now, of course, this is older. This is back to 23. Now you're going to see that it's bouncing down somewhere under the 5 range in 24 and 25. But the reason I went back to this point of time is because this is what hit the American consumer. This is what hit Main Street. This is what hit the landlord. This is what hit the homeowner. And so this is super reflective. And the point here, I think, if you just take a look at anything over the zero line, this is precisely why we should be investing in hard assets. Like there's no other reason just than this chart that you should be investing in hard assets. And I oftentimes like to tell the story about my mom, I talked to her just before I got on this call. She's a hairdresser, and my parents bought their home for $10,700 in the 60s. Okay. The home I grew up in, they still own. Okay. Super cool. Not so unique these days. That home's worth in the mid 700s, right? Now, my mom is not a real estate investor. I just want to point that out. She literally just provided a home for her family, right? Both my parents. What happened? Inflation brought her a paycheck on that house each and every year. And that's actually why I really believe in hard assets is inflation is, I know the Fed's target is 2%. They haven't gotten down there. They're sitting there, right below 3. Who knows what's really going to happen with this administration? But the last 10 years were like 36, 37% inflation. Okay. And so you take a look at a home that you bought for 500 grand 10 years ago, it's worth significantly more as a result of not because you're a great investor, but because you got in the game here. Now, your renter, this is going to be a tax. Your homeowner, your hard assets, whatever it is, it's going to be a payday. So, don't try to time inflation. It's going to be impossible to do. But anything above zero is a gift, right? And so this is different than real estate investing, but it's actually being in the right asset class. And so the reason why I wanted to show this, obviously going way back in before the 80s, is because inflation can be all over the place. And who benefits? People that aren't in cash, because what happens is your cash, it might be the same dollar amount, but it actually buys you less. And so I wanted to kind of end on this inflation piece because I think that real estate is an incredible inflation hedge too.
Yeah, and you guys have asked a ton of questions, and guess what? We're not done. We're going to answer questions. So definitely right now on your comment there, we've been monitoring it. We have a team behind the scenes that are monitoring the questions right now. And we have a whole Q&A portion of this. So a number of you guys have asked a lot of good questions. Now's the time to start putting more questions up. If you've gotten anything out of this webinar so far over the last hour and 40 minutes, right, then definitely stick around because we got more to give. And there is a recording, but there's more to give. Now's the time to start going on those comments and asking questions. So I will say one thing I want to add to the CPI and to the consumer inflation and all that great stuff that you're talking about, Ken, and how buying a home like your mom's home that bought for 10,000, worth 700 something now. There's a rule that this clicked for me many years ago with inflation. I used to do mutual funds. I used to do all that great stuff. And I always got told the rule of 72. Do you remember the rule of 72?
Yeah, but you got to dust it off for me.
Yeah. The rule of 72 is a very simple concept that if you take whatever compounding rate you're getting annualized and divide it into 72, it's a rough estimate to how many years it takes your money to double. So if inflation in reality is like 3% or averages 3% or something like that instead of 2, then that would mean that on average, things double in price every 24 years, right? In that example. So if you bought a piece of real estate and just bet on inflation raising the value of it, and it's only gained 3% annual appreciation, then in 24 years, you just doubled your real estate value, right? So as an example. So I think that like sometimes it's easy to see if just that thought made me go, oh, real estate's going to be worth more. So like that's the like that concept of the rule 72, which is so basic, so simple, goes, wait, real estate goes up with inflation. Over time, appreciation happens. So if I literally just buy it, it's going to be worth more eventually, right?
That's right. Yep.
But if you're starting at a $50,000 value, then yeah, okay, double is 100, by the way. But if you're starting at 400, double is 800. So that's where you see bigger trends. But that's it. So moving on to the next, Ken. Make sure you guys add your questions to the comments. There is a lot more time. Believe it or not, Ken and I blocked so much time for you guys. No matter what Ken says, he didn't want to do this, but he's here, right? And he's excited to answer lots of questions. Just joking. So Ken, what are you avoiding right now versus where you're looking? What are you staying from? Where are you staying away from right now? And what are you looking into?
Yeah, well, I'm looking at, I'm trying to stay away from syndicators that are trying to stay above water, and I'm looking into the where the debt funds or the banks actually took those deals back already. Mm-hmm. So it's less complicated. That it's already worked its way, and so that's the first thing. We're definitely looking at new construction, right? So there's a lot of people that have built that are having a tough time leasing up. And so there's tremendous opportunities there where, the lease ups are taking longer. They're having to use lots of concessions. The rents aren't what they thought they were. And their expenses are higher because they're spending a lot more on marketing and that kind of stuff. So in my lane, that's what I'm looking at. Obviously, I'm still looking at billboards. I'm going to talk about billboards. I want to do a panel on billboards, by the way.
We can do whatever we want.
Billboards. I love the billboard space. We bought a bunch in 25. And so, that's been great. Those are phenomenal bonus depreciation. We bought one in Ohio, and we got almost 98% bonus depreciation back. That's awesome. On the purchase. So, and so I'm staying away from anything that's obviously not fixed rate, and I want to be careful of markets that are not quite ready. Like Austin, I don't think is quite ready. Austin has to settle out a little bit more. So how do you know what if you have a market that's 2-3 months free? What happens is you go from 3 months free to 2 months free to 1 month free to a half to 100 off to stable. So the concessions as they roll out kind of roll back the other way, because you're not going to do 3 months if you don't have to. You're going to do 2. And then you're not going to do the 2 if you can do 1. So anyway, so those are the signs that, when that starts, I'll start looking at some of those, what I consider to be really, really good potential markets long-term. I actually consider Austin to be a great market long-term. And so it's got short-term pain. And so you just look at markets like that. I'm not convinced downtowns are where it's at either, right? So, we're kind of looking at submarkets to the downtowns more than anything.
Yeah, and like Ken, speaking of, yours specifically multifamily or just anything?
Yeah, for me, just multi. Yep.
Yeah. Just to clarify for everybody on that, and I would just say on my side, I'm staying away from single families that have a single exit strategy or single strategy, right? That only makes it work. I have friends that are really big into the midterm rental, short-term rental play, and they're making things cash flow today. But I would stay away from any property that it only works if you did one of those strategies. I've always been an advocate of that. I'm also staying away from any areas that has a competition with new builds, and where if there's a whole bunch of single families being built. I have a close friend that's a builder here in Austin who runs a very large, very well known, I'm not going to say who it is, building, developer and stuff like that here, not develop building and developer in the Austin area. And they just laid off half their staff, right? They still got tons of stuff out there on the market. And if you're a single family owner, that bought their property and you're trying to list your house right now during that same time period of competing, like that's just not, if you're a house flipper or anybody, like that's just not a good time, a good place to be anywhere near those developments and stuff. So staying away from that. I am looking into, and I would like to do a panel or a conversation at Limitless about ADUs, density, and so forth, right? So somebody mentioned blue state versus red state. Here's my experience, and can you tell me this, especially on single family? Red states don't like density, blue states do, right? As far as cities. And so so this is the catch-22, right? Like, so Texas, as an example, you got Lubbock, right? Which is a whole area. That's one of the most conservative red areas of all of Texas, right? They don't like density. Like everything's kind of sprawl. And you can see that in other cities too. Everything's just kind of sprawled out in a less density driven area versus major cities like Seattle, San Francisco, all that stuff. They're okay with density, but in order to solve it, what a lot of those, because of affordability is what they're focused on. A lot of those cities are starting to allow ADUs to be built on people's properties, right? But Seattle, for instance, just changed zoning basically that any property can have 3 units on it. So if you have a single family home in Seattle, depending on now lot size is a factor, and building setbacks and all that stuff is still a factor. You could put 2 more units on your single family home if you wanted to. And the reason why they're doing that is because they're trying to combat density issues without having to rezone to allow Ken to build a multifamily in the middle of a beautiful single family area. That would be a solution to reduce pricing. But they don't want to do that because that would piss everybody off. So instead, they allow single family homes to control their own density by adding 2 more units per thing, with no matter what you got, right? Basically. So I think that's an opportunity, right? For sure. It already has been a massive opportunity in Seattle, but there's other cities that are starting to do that, right? And so that's a good buy and hold opportunity. There's all sorts of things there. And I got strategies on that I love that work very, very well. So I'm looking into that type of stuff as well. And there's a lot more, but how do you solve like Ken said this number of years ago, especially in the single family space, how do you solve the affordability issue? That's how you go make money, right? And that's one way to do it. So anyways, good stuff. I've learned so much from you, Ken. Thank you. Right?
I think there were 47 red flags in there, weren't there?
Yeah, something like that. There's a whole bunch.
I might have did 48.
Dude, all right, we have a lot of friends that are like influencers, right? And they're all like, there's only 3 things you need to be successful in real estate. Like there's 86 things.
I know. I have a whole list here. Yeah, I mean, it's well over 47, but
there's so many.
We can keep going, but I know we're running out of time here.
Oh, we're not running out of time. I don't know where you got to go do, Ken. You got to
go on.
Something like that. All right. So essentially, we're going to answer a lot of questions, guys. But the bottom line is for us is that the investors who win in the next 24 months, we can read the signals before the crowd. Yeah, we have access to real information, not just what's on YouTube, right? Except for Ken's channel. Ken's channel you can get everything, right? Are you in rooms with people actively doing deals? And like I've said myself, and Ken says it too, networking is probably the biggest thing that's led to a lot of success for all of us, right?
By the way, also it's fun. Like birds of a feather flock together. I mean, we do stuff together. We ski together. We mountain bike together. We hike together. We get together socially. When we're in town, sometimes just for dinner.
Totally.
And it's as you guys, some of you, I trust me, especially if you started like we did in W-2s, like Tarl started off in the financial services business, like you feel like you're alone, right? Like, if you're trying to break out and just get an alternative view, trust me, it's worth the weekend. Even if you don't do anything, you're just gonna, you're gonna get more people in your tribe.
Yeah. And like I said, some of you guys are asking some really good questions here on the comments, and we're jumping into that here in about less than 2 minutes. So start stacking your questions in there. So some really good ones, Ken, actually, that I think we can work on. But that's it, guys. We're moving on so we're going to ask you guys questions. If you understood how to read the signals and you knew when to move and when to wait, and you could avoid deals that the property that Ken had in escrow, right? Do you think it'd be better positioned for what's to come, right? So the challenge is, how do you get access to those conversations? This August, yes, we're telling you about Limitless because that's what we do. We're putting together the room just for you guys. So this August, and we'll get into Q&A, we're going to build the room. So Ken and I have been doing this now. This is going to be the fifth year in a row that Ken and I have done Limitless Expo. And trust me, like, I'm not a long-term thinker. I'm not a long-term. I'm a house flipper, or former. I'm a recovering house flipper. 6 months. That's all I got. You want a business plan? 6 months. There you go. That's all we got. this is the first event. As soon as we did it, I'm like, we're going to do this every year. And so, and I can't believe it's been 5 years. It's just, it's insane to think that we've been doing this for 5 years. So August 14th to 16th, 2026, Phoenix, going to be nice, sunny,
Nice and yeah, beautiful
cool,
there.
Beautiful. There's pools at the resort. Don't worry. We usually average over 1,500 people there. Plenty of speakers, 3 days. Kiyosaki's there every year. Ken's there. George Gammon, plenty of buddies, 50 other people. Macroeconomics, real estate. It's not just real estate. It's business, finance, real estate, alternative investment opportunities like Ken's billboard scheme that he's got going on for bonus depreciation, and so much more that we go through. And these are movers and shakers. Like Ken and I essentially, and Ken, just correct me if I'm wrong on this, like we created this event because this is the event we want to we want to go to this event, right? Yeah. So we want to go to this event. And some of you guys even asked,
I want to listen to George Gammon. I want to listen to Bats. I want to listen to, people like that. And, there's some smart people out there.
Yeah. And we've had so many great experiences there. And so somebody asked a question on one of the chat things. It's like, hey, if I'm a new investor, why be lost in this room? And the truth is, like, there's going to be some stuff that's going to be over our heads a little bit if you're brand new to any type of investing, but that's how you learn, right? You don't learn by bringing the standard down. You learn by going up with it, right? So you learn by being around other people. It's that whole thing. You don't want to be the strongest person in the gym, right? You want to be competing against people stronger than you. You want to be the weakest person in the room in a sense so you can get stronger.
Yeah, that's what that's like.
Oh, totally. All the time. Being the strongest one in the gym, totally, bro. Like happens all the time, especially in jiu-jitsu, right? And so plenty of networking, plenty of great speakers. There's no green room. We don't have a green room. The speakers are there. The presenters are there. They're wandering around just like us. You could stop Ken in the hall. You can stop, unless he's busy, whatever. But there's so many people, so much opportunity. So we also have a huge expo hall, right? We usually, last year we had 76 vendors, right? We vet them all, right? As much as possible. We can't guarantee anything, but like we vet them as much as possible. And we also encourage you to bring your kids. So if you want your kids to learn and they're under 18, they can come for free. We're all for that. And so we're big on family. Ken and I are big on this, right? It's a huge thing for both of us, is making sure, how do we help, both the Ken's kids, right, are in the business, right? My kid's 5.5. He's forced to go whether he likes it or not. But that said, we're all about family. So lots of stuff we're going to go over. You guys can go on the website, right? And we also will continue to do these. So as you guys buy tickets, right, as you guys join the community, right, for Limitless, Ken and I host these leading up to it so we can prepare. So you don't have to wait till August, right? We just spent 2 hours. Ken just spent 2 hours, not at Limitless, 2 hours a day, breaking down what he's got going on. And we're going to go over more. There's a lot that's going to happen between now and August. So we're going to continue to do this type of stuff as you guys get involved with us. And because we're just that kind of people. So if one deal structured wrong costs you 100 to 500 grand, right? One tax strategy you're missing costs you a bunch of money. One market signal you miss costs you more money, right? Total exposure without current intelligence costs you tons of money. What will happen? Yeah, what is the cost of not going to Limitless is what we're basically trying to say there, right? So here's what it is. There's a discount code right now, webinar 10. If you guys want to go to limitlessexpo.com, there's essentially 3 ticket types. There's general admission. Right now, if you buy it at the door, which a lot of people wait for some reason, it's $1,600. Right now with the discount, $719. This is for webinar attendees only. VIP is where it's at. There is a huge experience for VIP. It sells out every single year, right? Every single year. We've already sold 80 of them and we're 6 months out. And so, but every year VIP sells out. There's also a virtual component. So if you're international, virtual is actually there as well. You can still get 10% off on a virtual if you can't make it in person. Last but not least, guys, there's a money back guarantee until May 6th. So if you guys decide to buy and use the discount, because prices go up on Limitless on Friday. So right now it is February 10th. On February 13th, we raise the prices for the ticket. So if you decide to buy between now and Friday, get the best. This is going to be the cheapest it's ever going to be. It's never going to be any cheaper. So webinar 10, you're going to get 10% off. It is as well as the super early bird price, because the price goes up Friday night. If you change your mind later or whatever, you have until May 6th to get a refund. No questions asked or anything like that. So you have 3 months to decide before if it's right for you. So choice for you, go to Phoenix, not Vegas, right? Spend 3 days with us. Meet Ken, meet me, meet everybody else that's speaking, right? Conversations that are making money, like silver, gold. That was a big thing for me, right? Or not. And you can continue to live your life. So check it out. Prices increased, not the 13th, sorry, the 14th. And the bonuses are there for webinar 10. Secure your seat now. It's easy. Go to the website, fill it out, buy virtual, VIP, general admission, whatever you want. Fill out the form, give us your money, secure your spot. We'll see you there. Anything else to add, Ken, before we get into Q&A?
I just love, first of all, thanks guys for hanging out so long. We hope you guys come. Obviously, it's an important event for us. We think this is a pivotal year for sure. And a great time to be looking at growth.
All right, so let's get into some questions. Oh, here we go. All right, so questions are popping up. There we go. I like this. Jeff, insurance. How do you predict it for next year? This is a good question. How do you predict it for next year? How do you get the deductibles down? We are paying way too much for less coverage today.
He's right. Like this is a super frustrating time. I saw your question. I don't know how to get deductibles down without having the premium go up. But I do. There's a couple things that you can do. One is if you've looked at captives, that's one area you can look at. If you look at insurance captives, you can join into a captive. Another one is what we've done is we've actually we've created a separate reserve account for a high deductible. So we took a bunch of money from all our projects and dumped it into an account. And so we have several $100,000 sitting in this account for what I would call kitchen fires and small stuff, right? Like, because, so we're covered on the big stuff. And so what we've chosen to do is raise our deductible and then just have the cash for, small stuff that you would normally turn over to an insurance company. And then if something big happens, you still have the proper insurance. But, we are shopping like crazy. So I think one of the problems is that not all insurance brokers are shopping the way you'd want to shop, and it's not as competitive as you think. So the right way to do it is we typically take it out to market each and every year, which obviously hopefully you're doing, and we don't just renew. So, but it's been super frustrating, and we really dig into our policy. What we realized, this is a while back, we hired a consultant from insurance, and she dug through all our policies, and she found a whole bunch of stuff in the policies that we actually didn't even need. Now, they weren't massive savings, but they were savings. So just little things that she's like, you need these things for sure, and you don't have them, and you definitely don't need these things. And, when you look at them, they're rather obvious, but those policies are complicated. Yeah. So that was what we did.
Yeah, and Ken, just so you like immediately, I'm like, oh yeah, let's just put $500,000 in a bank, whatever. But Ken's doing multifamily deals. You should do that. If you're buying $100 million deal, like, yeah, okay, that's different. But on a single family side of it, this is something I've just been doing for many years. And I've had major losses. We've actually had to file claims and had houses burned down and all that great stuff. And I'm very grateful when I have that insurance when that happens. Sometimes those are the best deals. But that said, we've had massive deductibles for a long time because, especially in flips and rehabs and construction, people, depending on where you're investing, you'll get people to break into your properties. They steal appliances, they do whatever. There's vandalism. And if we had $2,800 or $3,000 of appliances stolen, like the wrong thing to do on our side is file an insurance claim, because that could raise our rates later. It's only $2-3 grand, whatever, that sort of aspect. So exactly what Ken said is something we've been doing for single family for a long time, which minimum $5,000 deductible, if not higher, right? Deductible per single family for sure. And as well as like we fix our properties up. So I don't buy rentals that aren't fixed up. So I'm not worried about the sewer breaking. I'm not worried about a lot of things that might happen on a roof or whatever, because we've already fixed it. So I also reduce my risk on having to ever use insurance by just making sure the house is buttoned up and tight so I can get a higher value anyways. And that keeps our insurance costs down too. But it still sucks, right? No matter how you look at it. Property taxes too, by the way, especially in Texas. All right. Let's get another question up here. Will you have a discount code for Limitless VIP today? We do. Webinar 10. Discount code, 10% off. It is the cheapest it's ever going to be today for the rest of the year, right? It's not going to get cheaper. Like I said, if you guys decide that you want to buy today or by Friday, you actually have until Friday to make a decision. You will get the price, the cheapest it's ever going to be for the rest of the entire year. And you have until May to change your mind. So that said, lock it in. You can always change your mind later if you had to. Let's get to another question. I'm happy you guys chose this one, Mr. Moderators behind the scenes. I looked at this one. So Melissa, what would you look for when deciding whether to contribute to a capital call on a multifamily syndication? Not getting initial investment back either way, but trying to save half the deal.
Yeah, what a great question.
Yeah, very good question.
Okay, a couple things. I always look at the loan maturity is a big one, right? So if you're just renewing a rate cap or something, it's a little bit different. But I think how long is the syndicator, the GP, going to hold the project, and what is the underlying debt all about? I'm very bullish on the apartment market itself. And I know that it corrected in price. So what I want to make sure of is that, first of all, it was bought correctly. That would be a one. But two, is it in the right location? And that should have proved itself out. So I have no problem. Ross and I funded a bunch of stuff this last year personally on stuff that we're going to hold long term. And we know it's going to be years before we get our money back, but we like the asset. And we personally also did some cash calls as well. So, you got to look at the long term. I'm a long-term holder. I've never been in a situation where we have wanting to sell in 3 years after we value added something ever. That's just not our model. I'm always trying to grow the value, do a cash out refinance and return the capital. So I look at if this truly is a 5-10 year hold, it's in a great location, it was bought correctly, you have good debt on it, it's managed well. I know that's a lot, but those are all important. Those are things that I would consider before we did that.
That's good. So I don't have anything to add on that. The one of the questions that we see on here too is about family. So like, is it important to get your family involved? Coming to events like Limitless but even just financial education, and what age should us as parents start getting our kids involved in financial education and investing and all that great stuff? You've done a good job with your boys that I can see so far. I like your kids. I hang out with them, right? We're all going to go to the NCAA next month.
That's right. Cleveland, baby.
Yeah, Cleveland.
March. The NCAAs in Cleveland, wrestling. By the way, Tarl and I will be there.
We will be there.
It's going to be so fun. Yeah, I love, I'm a wrestling fan. I just was at a wrestling board meeting before this, which is why I got my ASU.
Sure
yeah, I mean, it's just, I think those kids are, just incredible people. Some of the most disciplined people you'll find. And so we'll be there. Can't wait.
Yeah, so kids we're big fans of that. So bring your kids. We'll let them in as long as they're under 18. And if they're in college, they count, right? They should buy a ticket, right? But we'll still give you a discount on your kids, no problem. But free kids, right? Not free kids, free to bring your kids.
Free
right?
kids.
Free kids. But like, I'll give you guys, I mean, my kid's 5.5, right? And we're hoping to have more. But he's been to every Limitless, right? Since he was a baby. But he's really into what we've done. He actually the other day he asked me if I can buy a certain thing, and I'm like, well, I want to put my money into something else. What do you think that is? And he's just like, houses. And I'm like, yeah. So why do you think I'm doing that? He's like, so people could pay you more money so you could buy more things later. And I'm like, that's exactly right. And so like, it's great, right? I love it, right?
5.
But then now he's like, when he looks at stuff now, he's like, I want to buy that. But how can I? And then he's thinking already, how do I make money to go buy that, right? Versus asking me for it. So besides point, all because of Limitless. That's not true, but we will actually have your kids come. I think it's important. We've been talking about this. We can't promise it yet, but if we can make it happen, we absolutely will announce the heck out of it. But there's been, we're trying to logistically figure out how to set up stuff for like teenagers to be more involved in quite a bit more at Limitless. and having like teenage tracks, have a whole room area where they can play cash flow quadrant and do a bunch of stuff, and being involved with other teenagers that are trying to figure out their own financials and be business owners and all that kind of stuff. So we are trying to figure out how we can logistically make that happen. So let's get another question going. What we got? All right. What do you think about the people who spend more time and energy on programs and coaching by actually? Okay, so what do you think about people that spend more time trying to sell coaching programs, right, versus actually building a portfolio? There you go.
Yeah, I don't think about them. Like,
Good answer.
yeah, no, it's a good question. I think what happens is a lot of people. I always, I was at my son's house on Super Bowl, and there was a young man in there that was really, MBA'd and all buttoned up, and he got his real estate development, stuff going, and I'm like, okay, how many, have you bought anything? Like, what'd you buy last year? Nothing. How about, okay, 2 years? You haven't done any kind of deal? No, not yet. Okay. Then I go to dinner with a buddy of mine and his 18-year-old kid. He helped her buy a house when she was 14. And she hasn't even been to college yet. And I was like, actually, I'm going to do a YouTube video with her. And I was like, she's already made like 250 grand in value, and she had like drug dealers in the house and all. She's got all these great stories. But I'm sitting there listening to, thinking of these two kids. Yeah. Like, what's the difference, right? The difference is one is just pouring themselves into more education, and one's actually doing it. So it's an interesting question. You do need education. Don't get me wrong, but at some point you got to pull the trigger, and that's really when you get your education. And so some people are just comfortable with going to these seminars.
Yeah, I would say, dude, I like making fun of this stuff. My Instagram channel is about making fun of these things that you're talking about, coaching and all that stuff, and gurus and everything. That's pretty much half my videos. But that said, there's time and a place for it, right? Like where there's some people that need that extra confidence where they're handheld and shown what to do and so forth. And I understand that and whatnot. But there's also just, I don't know, case in point, if somebody spends all their time on courses and saying that they're selling courses, how do they have time to actually do the real estate? And that's always been my kind of question on it. Now I have a joking video about how the new strategy, is basically how to you got to create a course first, then sell that course, and then take the money that you made from that course and then go buy real estate, and then talk about the real estate you bought with the money that you made from the courses, and then rinse and repeat and do it over and over again. But you made the course first, then the real estate second. Anyways, guess what? Whatever, right? Keep doing your thing. So, all right, let's move on. I work as a property underwriter. Oh, okay. Come on, guys. For those of us that own, operate, and also invest as an LP, limited partner, what do you see as trends for hold periods and returns?
Well, there's a lot to that question. Obviously, that person is very specifically tied to whatever their deal is, in what market, in what asset class, and how long they've been in it, how much money it is. So the truth is it's impossible to really answer. However, it's kind of back to the same old question, which is, do you believe in whatever you're buying in that particular market? There are markets that I think are perfect to exit at times, and there are markets that you want to hold longer term at times, and there's just so many factors as a result of that. It's all based on, do you need the money? Do you need the cash flow? Sometimes there's no cash flow, like on new development, new construction, but people oftentimes really like that. We have stuff like that going on right now. So it just completely depends on the investor, because we have LP investors that it's from their self-directed IRA, right? So it just depends on who.
All right, 50-year mortgage, good or bad?
What do you think?
I think it's going to happen whether we care or not. Meaning I think it doesn't matter. To me very much. I mean,
right? it has pros and cons to both. It lowers affordability, which is not a bad thing, but it does kick the can down the road and delays a lot of stuff. Spreads it out. I always tell people this story. Like when I first bought a car when I was a young man, uh, 36 months and 48 months were the only options. Like now, it's gone to 64, 72, 84, or I guess not 64, but it keeps going. Now, so what does that mean? What they're just trying to keep the payment down. Like, that's what that means. Like, miraculously, the cars have gone up, but your car payment hasn't really gone up because they just they spread it out over time. So that's essentially what's happening here.
Love it. There's one on here, Mr. Q&A people. How do you do this? I'm asking this one because I know I can answer this one. How do you determine if you hold a rental or flip it if there's good equity in it? That's a good question. So let's pretend that's single family or a 1 to 4 unit. So I'm going to make some assumptions here, right? This that you said, how do you determine if you hold a rental or flip it if there's good equity in it? So that means you already have the rental, which means you've already had it it's a rental, right? It's not a flip. So do you sell it or not, right? My concept has a lot to do with return on equity. So, which is if you're getting $200 a month in cash flow, then after everything, like everything's paid, whatever, that's $2,400 a year. If you have $100,000 of net equity means you've already paid everything. Your selling costs, real estate commissions, everything like that. And you net 100, then you're getting an ROI of 2.4% basically on that equity. And so now the question that I would ask is that, what can you do with that 100K, right? If you have no place to put it, then you probably shouldn't do anything, right? Can you 1031 exchange it into something else, right? Do you want to take the tax hit, right? If you don't, those are all factors. So I'm a huge believer when it comes to your single family stuff, especially, right? If you don't know what you're going to do with the money after you sell it, then don't sell it, right? That's a big part. If you like, I'll give you a story. One of my very first 1031 exchange was doing a math equation going like, wait, I'm getting 3% return on my equity. I was getting $350 a month in cash flow on the single family home. I then took that property, 1031'd it into a commercial property in downtown Tacoma. And it went from $350 a month to $900 a month in cash flow. But I didn't put any, I actually took 20K. Actually, I clawed back 20K, right? So I actually got some of it back, but no money out of pocket, no anything. And all I did was just take the property's equity and move it 1031 exchange to another property and almost triple my cash flow. And that was like revolutionary for me that I did. I'm like, I'm a genius. That's my first 1031, right? So that's how I look at rentals, to whether or not I should sell them or not. I don't know if you have any thoughts on that, Ken.
No, I completely agree with that strategy. I mean, it's great.
Yeah, I love it. I'm a huge fan, by the way. My entire strategy being a young 41-year-old real estate investor. Ken, when did you get started? Was your first deal? I think I heard you say when you were 34 or something.
30s, like yeah.
30,
Well,
okay.
I was managing. Remember, like right out of the
Yeah,
gate.
totally.
I was knocking heads with all the property managers, which I think was phenomenal.
Yeah, I had a revolutionary moment in my life by this guy named Saul. He's actually a Thatch Nguyen's mentor, right? Saul was a massive real estate dude in Seattle for a long time, and he said it to me, I think in 2016, and he was just like, sell 1031 exchange until it's exchanged into a property you would live in, right? And he's thinking about single family homes, right? Which means A class, like you'd like it, whatever. Then stop selling, just hold it forever, right? And that stuck with me for a really, really long time, going like, okay, he's like, never sell anything. And also the second thing he said is that at my age at the time, he's like, you're in the accumulation phase. So go buy more properties and then just keep them in 1031 forever, kind of thing. He's like, don't worry about like paying them all off right now. That was a big thing. He's just like, keep debt, accumulate, make sure they cash flow. And then over time, as you get older, 1031 exchange until they're in a property that you would live in, right? I'm like, okay. And I think that was really good for me to hear back then. So anyways.
Yep. Yeah. And by the way, that it's interesting because I think everybody feels like what we're talking about is new and itchy. Like
Yeah,
it's
yeah.
not like there are mentors and wise people years before us that have done this. All we're doing is
My
rinse and repeat.
dude, my favorite thing I heard from a old time real estate investor was when the Burr strategy came out: buy, rehab, rent, refinance, repeat. And he's like, isn't that just real estate investing? Like that's what you're supposed to do, right? You're supposed to buy a property,
I know.
fix it up. He's
Just
like, I've been doing
marketed
that for
it.
30 years. I guess I
Yeah,
just
I
didn't know it
know.
was called Burr.
Yeah, exactly.
Yeah,
Somebody just came up with an acronym.
yeah, right.
But yeah, it's true, right? Like every great idea has come from sitting in rooms like Limitless, and incorporating them into your strategy, right? Putting those tools in your tool belt.
Love it. All right, let's get into another question here. Go ahead, Mr. Q&A people, if you guys want to throw something up for us to talk about, or I can choose something. Oh, there you go. Wealth outside real estate. Is 2026 similar to a 2008 crash? You've talked about this before.
Yeah, this is Ryan Lee. By the way, shout out to him. He's got a great organization. He's coming to Limitless, by the way.
Mhm.
I recognize the handle, but no, it's extremely different. The difference is people have a lot of equity in their homes, and the correction in multifamily doesn't really hit Main Street like like it hits Wall Street. And ultimately, I guess it could hit Main Street in their quarterly statements, but it's extremely different. Where now we have an affordability problem. We didn't really have that then. And so banks were in trouble back then, and they're not really in trouble now. So and there's all these different things that are going on. So it's extremely different.
I dig it. So just a reminder to you guys, this Friday, Limitless tickets go up in price. So if you guys plan on going, now is the cheapest it will ever be and most affordable price it will ever be to get your Limitless ticket, right, for 2026, August 14th through the 16th in Phoenix, Arizona. Check it out. It's a beautiful resort. We've been there before. So if you came to the 2024 Limitless, we're going to the same, 2023 Limitless. We're going back to the same venue, the JW Desert Ridge. Awesome spot. Can't wait to have it. That said, Mark says, what are the keys to operations property management? This is a big question. Do you recommend self-managing to start or bringing in property managers?
Well, I recommend doing it yourself if you know how. Like if you're doing it to save money, then no.
Yeah.
Like, and so like if you don't know how to do it, then draft off somebody who does, and then do it yourself. So but just to jump in cold, horrible idea. So and that's actually one of the issues that we're starting to see today is these syndicators, they don't even know how to hire them because they don't know how to do it.
Yeah.
So it's really important you understand the game. That's a world that I'm from, and it's fascinating. And just like anything, the cream rises to the top, and there's extremely good operators, and there's a whole middle that is average, and then there's of course the ones at the bottom that are not great.
Yeah, I would, and we'll come back to that in a second. I would say if you're doing single family, right, same advice, same exact advice. And it also depends on whether you're local or not, if you want to run it or not. Like you're buying a job in a sense, like especially for those of us that are out there, not me, that focus on midterm rental, short-term rental. That's another. You're trying to property manage those. That's another whole business that you're creating in a sense. I would say property management is a business, and so you got to treat it like that. So one cheat code, though, by the way, right? If you're going to manage it yourself, is just do what we've done, which is make sure the properties are 100% fixed and dialed, and then there's no repair issues whatsoever. That also helps dramatically as well. You just got to deal with the lease ups. But all right. So, Ken, are you buying rare earths? Suggestions?
No, nah, we're not. But I'm open to it. If it cash flows.
Yeah, cash flows. So, I think something I learned from Robert Kiyosaki on gold and silver was like, because I felt the same way. I'm like, it doesn't produce any income, so why should I buy it? And I was like, this is taking money off the table, right? This is taking chips off the table. That stuck with me really
Yeah,
big.
I'm not averse to it. I just don't understand it like I do. And, I'm always learning. And so, if we can get somebody like that to Limitless, I can listen to them and educate. I would highly educate myself before I jumped in.
Agreed. Just like crypto. What should we as investors be doing now to prepare and protect our portfolios? Didn't we just talk about that for 2.5 hours?
Yep, I think so. But I think the one thing is take care of your tenants. Like communicate with them, fix whatever they want, renew their leases at the existing rents. Don't try to increase rents, and keep the place looking great.
I could not agree more. We had a whole thing on all our portfolio about 18 months ago that was like, don't do anything to upset our tenants. Like, keep everybody happy, and it's worked out pretty good. All right, so can you do a quick I guess on this webinar's agenda, the 3 warning signs that you mentioned? You had like 3 charts, right? What were those again?
Dude, don't ask me. I have no clue. I have to go back. I mean, I wrote them. I'm kidding. I'm kidding. I'm like, really, like, you're gonna piss off, most of the people here that stayed from the beginning.
Understood. All right. Well, let's go. All right. Let's go through another question. Thank you, Q&A people. That was a great question. Thoughts on ground up multifamily development, private investments in the Sunbelt areas. I'm looking for deals. My concern is Sunbelt is currently oversupply and uncertainty in construction costs.
So just to be clear, Sunbelt is a big area.
It's a very big area.
When they say oversupply, I sometimes, I disagree with a lot of what they have to say. The construction costs have gone down because, there's nobody building. So, when there's nobody building, you get better pricing. And, and it's, we already went through the oversupply issue. And so, what's hitting today is going to be fully absorbed in a year and a half, let's say, maybe 2. And so breaking ground today on something that is going to open in 24 months, 36 months is not a bad strategy, because guess what? There's not going to be a lot of competition then. So again, it's market timing, but there are areas of the Sun Belt, which is like, call it 1/4 of the United States, like that are overbuilt for sure, and there are areas that are underbuilt. But we're not seeing construction costs. We've seen a big decrease.
Love it. One question that was asked a long time ago, so the Q&A people probably won't find it. But if I'm looking to start investing in single family properties, which metrics should I consider? A lot of stuff that Ken talked about with multifamily, about, are people moving there? Are they not? Like, it goes back to something that Ken has said many times. Like, in order to do real estate, you need people, right? So are people living there, or are they not living there? Are they going to it or away from it? Are there jobs? Is it a one-horse town, right? Or sorry, one show, whatever they call it. Like, they have one industry, right? Those are all factors. I'm a believer in single family that you can invest in pretty much any market as long as you buy right? And and there's still people there. They're not leaving the area. That's a key aspect. Single family is a little bit more forgiving if you're buying one at a time, in my opinion. And so I would be more concerned about the strategy that you're focused on in your area, more than anything. So I'm a big fan right now with having to wait out the storm. I don't know where the market's going to go or anything like that. Is buying properties with multiple strategies that you can accomplish on it, not one strategy. Like, I'm not buying like right now, actually, you talked about foreclosures earlier, right? We had a property that we put an offer on a few days ago, and it had multiple offers. Great. But I put a low offer in. Like, the thing was listed for, like, let's say 330, and I put it at 285. But hard earnest money, close quick, all that great stuff. I thought it was a foreclosure, by the way. Like, it was a hard money lender foreclosure. So which is interesting, because the people in the single family that is getting foreclosed on, a lot of them aren't homeowners, they're investors. And so they're the same thing that happened with what Ken talked about with the bridge loans and all the great stuff and the variable rates. That's happened with people that were house flippers and people that bought in 2024 and so forth, that didn't finish the deal, or 2023 that didn't finish the deal, and now that loan's coming due. So that said, while we were on the webinar, I just got an email or a text message saying, like, hey, they want to take your offer. And I'm like, what? So what did I do wrong? So they want to take my offer. But that said, that particular property, yeah, sure, I could flip it, but also I can keep it and build an ADU on. I could build 2 ADU on it as well. I can midterm rental it if I wanted to. I don't want to. But I have a lot of strategy. I can do a lot of stuff with this property at that price and raise the value and flip it and so forth. So I'm looking for those, very protected and insulated because of that. So anyways, are you smiling because I ranted on something?
Oh no, I love it. I just sat and listened.
Yeah, right. I hope you learned something, Ken. You should take notes from
I
me.
always learn.
You know, if you buy right, you're always going to make money, Ken. I don't know if you knew that or not.
I learned that I can take a break when you're talking.
Yeah, that's good. That's what I'm here for, bro. All right. So Limitless Expo, guys. It is coming up fast. It's going to show up. Ken and I had no idea we'd be promoting it this soon already since the last Limitless Expo. We are excited to get on this train. And a lot's going to happen in 2026. We don't even know what we're going to be talking about in August. Ken and I, when we make our schedule and agenda for Limitless, which we're doing part of it later this week too, is we save whole sections of the agenda for who knows what's going to happen between now and 6 months from now, right? Basically. And we purposely allocate slots and topics and things for just in case, like something's going to happen, whatever, right? So that's just what we do. And I love it. So Friday night, ticket prices go up. This is your cheapest you're ever going to get it. So even if you don't know you're going to go, you could buy it now, guaranteed you refund till May. And if you're international, a lot of you guys are watching this internationally, we have a virtual component. The virtual component isn't just watching videos, it's interactive. Our app that we have at the event is very, very much designed so that you can interact with people, even if you're virtual. It's very, very hands-on. It's very interactive. So any more questions, guys, or what you got, Ken?
Oh man, this is fantastic. By the
2.5 hours.
Yeah, well done.
Bring it. All right, we got another one we're going to do at some point, guys. Oh, Q&A guys want us to answer another question. Okay, throw one more up there. Let's go. My property has vacancy issues. Rents are at market. What are your 4 best strategies to increase occupancy?
Okay, so the first thing is maybe your rents should not be at market. So I know that's counter to probably what you want, but why would your rents be at market and you have high vacancy unless you're selling or trying to refinance? So you're better off to be under market and higher. So the second thing is, what's your traffic? Like how many people are actually showing up? 0 a day or 5 a day? And if there's 5 a day, what are they seeing? Maybe it sucks. Maybe the units suck. Maybe the clubhouse sucks. Maybe the people suck. I don't really know.
Ken's getting tired. You could tell.
But no, really, this is the way I look at my own assets. I'm like, what was the traffic today? We had 4 people tour. Why didn't they rent? Well, it could be market. Maybe it's priced too high. It could be that the unit they saw, didn't appeal to them for, if not why. It could be my own people. So it all starts with traffic. It's like anything, it's, you have to have a lot of traffic to fill vacancies, period. And there's so many ways to generate traffic. And so I don't know what the location is, if it's drive-by, if it's behind a shopping center, nobody can find it, whatever. There's a zillion things. But then when they show up, is it a place that, I would say, is it a place you want to take your girlfriend on a date? Like seriously. Or does it have all this deferred maintenance? Does it look like crap from the outside? So there's all these things that contribute from a renter's standpoint. That's more than 4, but you got to do a full assessment. And what happens is a lot of times people have rose-colored glasses on with their own assets, and they're like, but I would start with, who cares if you're at market rent if you're highly vacant? Like, you know what I mean? Like, I'm like, look, you keep your rents below market, because what you're really trying to solve right now for is cash flow, unless you're trying to sell it. And if you're trying to sell it, then maximize your rents. But if you're not, why not give your renter a break and give yourself a little bit of grace so you can sleep better at night with a higher occupancy. So, it's not always prudent to push market rent, especially in a market like this. Renters are driving everything, and so yeah, there's a little bit of a disconnect there. I appreciate the truthfulness in the statement, but if you have high vacancy and high market rent, like, it's pretty obvious to me, that's not a good combo.
So one other last thing to comment on as well is that we actually didn't bring up AI. I know you bring it up a lot on your on your YouTube channel as
I
well
thought you
as.
were doing AI right now.
Oh, dude, I love it. So, no, actually, true thing. We are going to talk about a lot of AI this year at Limitless. And we really didn't have enough sessions on it last year, but we're going to, I mean, obviously a lot of stuff's going on with it. You talk about a lot on your YouTube, but
yeah,
something that I'll be full disclosure on our side. We have 3 main companies, right? That we run, and it's great. So, real estate, we have a hard money company. We have real estate investment. That's my main thing. My hard money lending company that I do as well. And then we have our events business, which runs Limitless with Ken. And we just dove into AI on the events business big time. And I think we'll definitely, maybe when we have these guys out at Limitless that help do this, but essentially we built our events company like its own AI, like in a sense, right? To where it is our brains, our collaboration between me and my COO and a bunch of other people and everything like that. And like it is our events company, right? In a sense. And so my staff uses it, everybody's in it. It knows the intricacies of everything when it comes to like how we run the operations, which has allowed us to scale the events business without having to hire more people, which is what Ken talks. I know, Ken, you talked about this on your YouTube channel quite a bit, which is in a sense of like, it's not that people are going to fire people, is that they're going to, not replace them, but then 2, use AI to go leverage up without having to hire more people and build operations. And that's exactly what we're doing.
How do you double the size of your business without doubling the size of your payroll?
Correct. Yeah. And I think it's still going to, so we're going to definitely be talking about AI, but we're going to talk about unemployment. And Ken, I sent you a screenshot the other day about how many applicants we had for one of the positions.
Crazy.
It ended up, when I sent it to you, it was like 980 applicants. We had over 1,100 applicants for this one position in our company. And it's like a decent, it's an $80,000 a year salary position, right? And we had over 1,100 applicants for it. And we had one lucky person who starts with us tomorrow, right? So,
how do you sort through that?
Dude, that's dude, I could do a webinar on that, dude. I actually think we're pretty good at it.
Use AI to sort through 1,100 applicants.
For a long time, no. But actually, what we ended up doing was, I created this funnel system we did a long time ago for getting good applicants. I mean, you've met my team. My team's awesome. Everybody's culturally awesome.
Incredible.
If there's anything, now we don't have 300 people, so it's easy to get awesome with a team of 10, right? It's hard to get awesome with a team of whatever, hundreds, right? I understand that. But yeah, what we ended up doing is we recorded how we interview people and how we do stuff. And then we took those bites and then we made and we get a lot of data, disc profiles and all those other things. And we shoved everybody in a filter using the AI model that we use, and then sent them a bunch of questions that we wanted them to answer. And then how we used them, we sent it back to the filter again. Then we checked to see if they used AI to answer those questions. And we had this whole freaking thing. And then we had our AI listen to our interviews to see if are we favoring somebody for something, or we're doing whatever, all these factors. It was awesome. And so, yeah, so now if next week we're firing that person that we hired because it didn't, then maybe it's not so awesome after all.
No, is that true?
No, I'm joking. Like in a sense,
gosh, it was like,
it didn't work actually.
Oh my gosh, that's funny.
I don't think that's going to be the case at all. So, besides point. All right, guys, Limitless Expo. Ken's tired. All right, he's had a busy day, right? So
I did a 2-hour podcast with Grant Cardone today.
Oh man, that's another whole conversation that we can have.
I know. It was really interesting. He asked me to come on his channel. We've never done one together, and I did one this morning. And so yeah, I've been on Zooms for 5 hours today.
Awesome. So, all right, guys, lots of time. You don't have much time though to buy your ticket. So make sure you guys get your ticket before Friday night. That's when prices go up. They will never be more affordable than right now for the Limitless Expo. Go to limitlessexpo.com and check it out. You can see a lot of the details that are there. We're just going to keep announcing more and more and more cool stuff about Limitless as we get closer to the event. More sessions will get announced, more speakers will get announced, everything will keep getting announcing, but it's not going to get cheaper. It's going to get more expensive. So take advantage of it now. You can refund in May if you had to. Not saying you should, but there's really no risk, right? So if you plan on going, mark your calendars, August 14th through the 16th, JW, Desert Ridge. Ken and I will be there. Many other people will be there. And we hope to see you guys.
Yeah, we hope to see you guys. Yeah. And thanks for everyone for sticking with us.
It's a long one, right? So hey, we got a longer one we're gonna do. Do you guys know that? I don't have the dates in front of me right now. Ken
You
is
give
so
me anxiety
excited.
just talking
Yeah.
about it. So
Ken
no.
is so excited to find out that we are actually going to do probably a 6-hour one of these in, I think, April, right? And it's going to be a mini event all of its own, right? Multiple people coming in and out. It's going to be great, right? But it's all in preparation as we get closer and closer and closer to Limitless. So can't wait for that one, Ken, right? So do your stretches. Don't do a podcast before that one. And we'll get going. So, all right, guys. Thanks, Ken. Thanks, everybody.
Hey, Tarl, as always. Yeah, thanks everybody for watching.